Good morning, friends. Good morning, friends. Okay, let's continue with the discussion. In the previous session, we are done with three chapters. Today, I'm starting with the fourth chapter of Block 1, which is your dividend decision. A fairly small chapter, very simple, maybe 1.5 hours of discussion. What we do here is we try to find how does dividend impact the share price of a company, and how can an organization decide how much dividends have to be paid, because at the end of the year when profits are made, organization need to decide how much should be paid in the form of dividends and how much should be retained by the company. We have some 3 4 models of valuation here, and 2 models to decide what should be the dividend payout. We'll directly start with questions as we did earlier. Let's come to question 1. For following information is given for QB Limited. Net profit for the year: 12% preference share capital, equity share capital, retention ratio, cost of capital, internal rate of return on investment. Calculate the market price per share using Gordon's formula and Walter's formula. So they have asked us two approaches. Gordon is something I've already explained when we did KE formula. So same KE formula will be interchange and we get the Gordon's formula. So the KE formula used to be K is equal to D1 by P naught plus growth rate. Growth rate comes this side, it becomes Ke minus G is equal to D1 by P naught. P naught comes this side, P naught is equal to D1 by Ke minus G. This is the Gordon's formula. We will use this. The headache is going to be again, what should I take the given dividend to be? Should I take it as D0 or D1? In this question, clarity is missing. Ideally, two different answers we can give. So let's start. Gordon's formula. Gordon's approach. In order to do the Gordon's approach, I will first need certain information like the cost of equity, the dividend, growth rate, all that we will calculate. We have been given net profit for the year. Preference share capital is there. From net profit, if I deduct preference dividend, I'll get EAES, we'll get EPS. So EPS is equal to, first point, EPS is equal to EAES, EAES divided by number of equity shares. Number of equity shares, 30 lakh minus 30 lakh is the net profit. Preference dividend is 12 lakh. Preference dividend is 12 lakh. 30 lakh, 1 crore into 12%, 12 lakh is the preference dividend. Divided by how many shares are there? 60 lakh divided by 10, 6 lakh shares are there. 6 lakh shares are there. This will give us earnings per share. How much is earnings per share? 3. Dividend per share is equal to EPS into payout ratio. EPS into payout ratio, 3 into the retention is 75%, which means payout is balance 25%. Retention 75% as per the question. Payout is 25%. 0.75 per share. Growth equal to ROE into retention ratio. ROE, IRR, ROI, ROCE, different names can be used in the question. ROE into retention ratio. ROE given in the question, internal rate of return on investment 22%, retention is 75%. So growth is ROE, retention, return on equity into retention ratio, 22 into 75%, 16.5. DPS of 0.75 taken as D0, sorry, D1. First, let's take it as D1. Taken as D1. We'll have to give two answers. One taking it as D1, second taking it as D0. .75 as it is D1. What's the cost of capital or cost of equity? 18%. Growth rate is 16.5%. 16.5%. Growth rate 16.5. This will give you the value. Was the answer? How much? 5, 500. 50. Okay. 50 is the answer. Rupees 50. This is taking it as D1. The dividend is taken as D1 rupees 50. If you take the same dividend as D0, then with this add growth rate. With this add the growth rate. Another answer where you take the dividend to be D0. Clarity is not there when this dividend would be paid. Because of lack of clarity, we are taking two different assumptions. One taking it as D0, another taking it as D1. 0.75 plus 16.5%. Tell me the revised answer. Two different answers. 58.25. This is under Gordon's approach. Walter, we will not have this issue, but Gordon, we may have to give two answers if clarity is missing. Any doubts on this? Then Walter's model, a fairly simple approach. Walter's model, P naught is equal to, as per Walter model, there are two parts to the valuation. One is what you pay, second what you retain. What you pay is called D by KE, dividend by cost of equity, same as the Gordon's formula, dividend by cost of equity, no concept of growth rate and all, plus whatever we retain, we'll have a multiplier on that called as R by E, R by KE, R by KE into E minus D whole divided by KE. Both have a denominator of only KE only. The only thing is the dividend part is divided by KE, retained earning part is also divided by KE, but there is a multiplier on top of it called R by KE. R by KE is an extra add-on in the formula. D by KE plus R by KE into E minus D divided by KE. Dividend is 0.75. Cost of equity is 0.18. R 0.22 by 0.18. $19.45. Let me know if you get anything different here. Very simple. The only thing is in the Walters model, you will have to add a formula in the formula and multiplier. Otherwise, it's technically dividend plus retained earnings by cost of equity. Dividend plus retained earnings by cost of equity. Any doubts on this? Clear? Can you proceed? Let's come to this. Return on equity of Satwa Limited is 15% and the capitalization rate is 20%. Book value per share is 125. Calculate the intrinsic value today using Gordon's model and Walters model if the company's policy is to retain 65% of the earning. Again, same two things have been asked. One is Walter model and second is Gordon's model. Only thing here is they have given book value per share. ROE, you would have seen this formula in ratio analysis. What is the formula for ROE? EA ES divided by amount of equity. EAES divided by amount of equity. EAES, if we divide by number of share, we get earnings per share. EAES divided by number of share is earnings per share. So ROE has another formula called earnings per share by book value per share. Earnings per share by book value per share. Using this formula, we will get EPS, then we will get dividend per share and apply both the formula. So here ROE is equal to EPS by BBPS. EPS by BBPS. The normal formula for ROE is earnings available to equity shareholders divided by amount of equity. Let's start doing it. Question 2. Question 2. Walters model. Walters model. ROE is equal to EPS by BBPS. EPS by BBPS. Earnings per share by book value per share. 15% equal to EPS by 125. This will give us earnings per share, and then we use the same formula where we bifurcate the earnings into dividend and retained earnings with a multiplier effect. 15% is equal to EPS by 125 was the earnings per share. 18.75. Please apply the formula now. That's all. I think my discussion is over. 18.75. Apply the formula. Refer the screen in case you get a doubt. Otherwise, you apply the formula. %35 is paid out. And 65% is retained. Let me know if you get anything different here. Gordon, no choice. You'll have to give two answers. One assuming it as D0, second assuming it as D1. Clarity is not there. When the dividend will be paid. We do not know when the dividend would be paid. So two answers for Gordon's model. Any doubts on the Walters model? Any doubts on the Walters model? Clear? Gordon's model. Gordon's model. Dividend of that 18.75 into 35%. DPS of 6.56. The dividend of 6.56. I have two choices. Take it as D0, take it as D1, and automatically the answer will change based on that. D1. I'll give only one answer in the class now. Taken as D1. Taken as D1. Any doubts on the Walters model? In the Gordon's model, first thing you have to do is a growth rate calculation. Growth rate is ROE into retention ratio. Once the growth rate is computed, then we go ahead and do the balance calculation. Growth rate is equal to ROE into retention ratio. ROE into retention ratio, 15% into 65%. You get 64 as the answer. Let me know if there are any doubts here. Any doubts on the Gordon's model? Gordon, I don't want to spend much time because we have already done in cost of equity part. Walter, the two parts to the valuation: one, what is paid, and second, what is retained by the organization. Any doubts on this? Clear? You see two different answers for Gordon's model. So always two answers would be needed for Gordon's model depending on the assumption you take. It is all assumption based answer. Preferable to write two different answers in exam. Okay, coming to 3. Similar to the first question we did today. Here, can you proceed to 3? Go through question 3. Okay. Similar to the first question we did, the only difference here is they have asked us to find out what should be the dividend payment, because I am giving you the price directly in the question. The price should be 42 rupees and dividend is the balancing figure which we need to calculate, and based on that we have to calculate dividend payout ratio. So dividend is the balancing figure here. Price is directly given in the question. Price has to be 42 as per this model. They want the price to be 42 rupees. Let's start. First is earnings per share. Earnings per share is equal to PAT minus preference dividend divided by number of equity shares. PAT minus preference dividend divided by number of equity shares. PAT minus preference dividend divided by number of equity share. 30 lakh minus, how much the preference dividend? 12 lakh. Number of equity shares? 3 lakh. This will give us the earnings per share. How much? 6. Now from this 6, I have to decide what should be the dividend and what should be the retained earnings. Walter's formula, let's write first. P naught is equal to, let's write the Walter's formula. and then dividend is what we are going to calculate. We want the price to be 42. Price has to be 42. Dividend is what we are trying to calculate. P naught is equal to D by KE plus R by KE into E minus D divided by KE. We want the price to be how much? 42 is equal to D is balancing figure. KE is, please write in decimal. Sometimes percentage you can make a mistake. 0.16. R is 0.20. 0.16. E is 6 rupees. D is what we are trying to calculate. D is what we are trying to calculate. 42 is equal to D by 0.16 plus 0.20 by 0.16 into 6 minus D. 0.16 is common. I take it to the other side. 42 into 0.16 is equal to D plus 1.25, 6 minus D. Solve this, you will get the answer to D. That's the dividend. And from there, we will decide the payout ratio. 42 into 0.16, 0.16 goes to the other side, is equal to D plus 1.25 into 6 minus D. 1.25 into 6 minus D. This will give you the dividend number. Solve this and let me know what's the dividend you get. 3.12. With this, my answer will not get over. I have to tell what is the payout ratio. This is the dividend. They want us to calculate what should be the payout ratio. Dividend is 3.12. I'll pay a dividend of 3.12 per share. Dividend is 3.12 per share, and based on this, I will calculate the payout ratio. Any doubts on 3.12 first? Any doubts on 3.12? Then dividend payout ratio is equal to, dividend payout ratio is equal to 3.12 by 6, 52%. We'll have a payout ratio of 52%. Clear? Any doubts on this? Payout ratio 52%. Let's come to 4. A firm has paid a dividend of 2 per share last year. Estimated growth rate is 5% per annum. Determine the market price if the growth rate rises to 8, falls to 3. Also find out the present market price given that required rate of return of the equity investor is 15.5%. Ignoring the heading, there's nothing in the question to indicate it is a Walters model or a Gordon's model. Now, wherever growth rate information is there, only Gordon is possible. Walter cannot be used. So, in this question, we are first going to calculate the price with a growth rate of 5%, then change the growth rate to 8%, another price, change the growth rate to 3%, another price. One good part is this is very clear. Is it D0, D1? D0. This is very clear. It is D0. So that confusion at least is not there, because I cannot give for 3 situation 2 different answers. So here, like original situation, P naught is equal to D1. You can keep doing it. Refer the screen if you want. It is a very simple one. KE minus G. 3 different growth rates you have to apply. Three different growth rates have been given in the question, and the price will keep changing based on the changes in growth rate. Twenty, 28.8, and 16.48. Any doubts on this? Walter is anyway not possible here because for Walter I need earnings per share and all, which is not there. Any doubts? Let's come to this. This is a slightly different question. Go through the question first. Okay, Mr. A has gathered the following information. A company pays regular dividend, last interim dividend for the quarter. So the annual dividend for the last year is 12 rupees per share. Quarterly dividend is 3 rupees per share. So D0 is 12 rupees last year dividend. Owing to a wide market reach, turnover has a CAGR of 25%. The turnover is expected to grow. Turnover growth is not dividend growth, only turnover growth they have given. And ROI or ROE, they have given three situations. When they give situation and probability, we'll have to take a weighted average of this to get a single ROI number. I cannot have three different ROI number. So I'll take a weighted average and that will give me ROE, ROI, ROCE, whatever name you want to call. And the retention ratio, I have last 5-year data and the company plans to retain based on the average. So ROE into retention will give me the growth rate. Current interest rate is 4.5, beta is 1.3, market return 12.5. This will give me cost of equity. They have asked us to do Gordon's model as well as Walter's model. I'll focus only on the Gordon's model. Walter's model, exactly the same thing we have to repeat. Now, let's first get the base information. Dividend of last year, dividend of last year, 3 into 4 quarters. 3 into 4 quarters, 12 is D0. Dividend of last year, D0 is 12 rupees. Last quarter, 12 rupees dividend we have paid, which is technically D0. On top of it, we'll have to do certain extra calculation. First is ROE or ROI is equal to weighted average. ROE slash ROI is equal to three situations. 20 into 0.3, it can be 20%, it can be 30%, or it can be 18%. Weighted average of the three numbers, 20, 30 and 18. 20 into 0.3, 30 into 0.2, 18 into 0.5. All put together single ROI number. How much? 21%. So instead of having multiple ROI number, we have converted into a single ROI number. Retention ratio, they have said take average of the last 5. Retention ratio is equal to 40, 65, 50, 45, 30, 5 years. What's the retention ratio? 46%. Growth rate is equal to ROE into retention ratio 21 into 46%. ROE into retention ratio 21 into 46%. Very good problem. 9.66%. ROE into retention ratio. They had given three different ROE situation. We took a weighted average of that and got a single ROE number. ROE into retention ratio 9.66%. Clear? Then the last part is K is equal to cost of equity is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. RF is how much? 4.5. Beta is 1.3. Market return is 12.5 minus 4.5. 12.5 minus 4.5. Sorry, 14.9%. Let's use the formula now. P naught is equal to D1 divided by KE minus G. D1 by KE minus G. 12 plus 9.66%. Dividend will increase at the rate of 9.66%. $251.13. Any doubts on this? This is Gordon's model. When you do Walter's model, you will need earnings per share. What will be earnings per share is dividend per share is 54% of earnings. Dividend per share is 54% of earnings because retention is 46%. So dividend is 54% of earning, that will give you the earning, and balance is same calculation. So we got the answer as 251.13. And when you do the other model, as I said, you will have to calculate the earnings per share. Earnings per share is going to be dividend per share divided by 54%. Divide by 54%. Any doubts on this? Go through 6. It's a slightly different question again. Okay. Vista Limited retained earnings is 3.60 per share. Retained earnings is 3.60 per share, which is 40%. This will give me the earnings per share. Company is foreseeing a growth of 10% for the next 2 years. After that, growth will stabilize at 8% per annum. Company will maintain its existing payout ratio if the investors required rate of return is cost of equity. What is the intrinsic value per share using dividend discount model? Now, dividend discount model is nothing but Gordon's model. The problem for Gordon's model is P naught is equal to D1 by KE minus G. But today, when I sit and look at growth rate, is two different numbers. It is 10% for 2 years, and then it is 8% thereafter. When I ask this question, we are giving an answer saying growth rate is 10 and 8. I cannot use it in the formula. So what Gordon said is, you cannot use my formula till you give me a single growth rate. So 1 year got over. If 1 year gets over, P1 is equal to D2 by KE minus G. P1 is equal to D2 by KE minus G. 1 year got over. I asked the same question. Again, you are telling me 10 and 8. Why 10 and 8? Because first year 10% happened. Second year also growth is 10%. Third year onwards only growth is 8%. I say let one more year get over. When one more year get over, P2 is equal to D3. This time when I ask what is the growth rate, you are giving me a single answer. When I ask what is the growth rate after 2 years get over, you give me a single answer saying 8%. Till growth becomes a single number, you cannot use this formula. So what Gordon said is, in case there is a step up growth model or the growth is changing, step up, step down, whatever happens, you keep calculating dividend and then value the share at the end of second, third, fourth, fifth, sixth, seventh, eighth. And our assumption is, I buy the share today, get first year dividend, second year dividend, third year, fourth year, whenever stability happens. At the beginning of the stability, I sell the share. Whether I sell, I don't sell, doesn't really matter. And here we are going to do the valuation using this logic which I had done in the previous class. Valuation of bond, year, cash flow, PVF, DCF, first year dividend, second year dividend, third year dividend, fourth year dividend, fifth year dividend, and then sell the share. Whenever you can sell the share whenever you want. So our assumption is, here I'll get first year dividend income, second year dividend income, and at the end of second year I'll sell the share. Why at the end of second year? Because I can do the valuation at the end of second year. Assuming you can do valuation at the end of first year dividend, at the end of first year sell it. Whenever you can do valuation, you sell it and then complete the valuation. So here I'll have to calculate first year dividend, second year dividend, and price at the end of second year. For getting price at the end of second year, I need the third year dividend. So working note 1, computation of dividends till first year of stability, year 3. First year of stability is year 3. Till stability happens, you'll have to calculate the dividend. Year earnings per share, dividend per share. Earnings per share and dividend per share. Year 0, first let's write the year 0 numbers and thereafter we'll do the year 0, or technically the last year number. Last year it says retained earnings is 3.6, and which is 40%. Retained earnings 40% is 3.6. So earnings is 3.6 by 40%, 9. And in this 9 into 60% is payout, 5.4. First year earnings will grow at what rate they've said? Company is foreseeing a growth rate of 10%. So 9 will become 9.9 into 60%, 5.94, or you can say 5.4 plus 10% also. 9.9 into 60%. Year 2, 9.9 plus 10%. 10% we are growing. 9.9 plus 10%, how much? And 10.89 into 60%. 6 point. Third year is the year of stability and the growth rate is different now. Third year is the year of stability and the growth rate is different. 10.89 plus how much? 8%. Growth goes down to 8%. 11.7612. Sometimes in the third year they can change the payout ratio also. It says company will maintain the payout ratio. Reason for calculating EPS is suddenly in the third year they may change the payout ratio. In that case 11.76 into the new payout ratio. Here the payout ratio is 60%. 0567. 4 decimal is fine. 0567. Now what I am going to do is I'll buy the share today. What price I don't know, that's what I'm trying to calculate. First year I'll get dividend income, second year I'll get dividend income, and at the end of second year I'll sell the share. Present value of future cash flow. Present value of future cash flow will give you the value of the share. That is what we are trying to do here. Present value of future cash flow. Now right, valuation of share. Year cash flow PVF DCF. Some discount rate would have been given. PVF at what rate? 15%. DCF. Year cash flow PVF at 15% and DCF. Year 1 I get dividend income of 5.94. Year 2 I get dividend income of 6.534, and at the end of year 2, I'll sell the share. How do I sell the share? P2 is equal to D3 by KE minus G. P2 is equal to D3 by KE minus G. So come down, P2 is equal to D3 by KE minus G. D3 by KE minus G, 7.0567, 0.15 minus. When I'm in the end of second year, when I ask what is the growth rate, we get only one answer. The one answer is what? What is the growth rate? 8%. Earlier, this formula cannot be used because we are having two different growth rates. Hundred point. That's all. Do PVF at 15%. DCF 2 decimal, PVF 3 decimal. Problem is silent. What was the total? 86.3. 32, 3233, whatever, 86, around 86 rupees. If it is the same growth rate every year, then we can directly use the Gordon's formula. The problem is growth rate changes, and which is very much possible in the practical world. Clear? Any doubts in this? Done? Can you proceed? Okay. Almost similar concept. Go through it and then I'll explain. Okay. Now they are not talked about any model, everything, but let's first understand. Mr. A is thinking of buying shares at 500 each, having a face value of 100. He is expecting a bonus at the ratio of 1 is to 5 at the end of fourth year, dividend 20%. He intends to sell the shares at the end of seventh year at a price of 900 each. Purchase and sale, some incidental expenses are there. Practical world, some brokerage charges will be there. He wants a return of 12%. Return of 12% is KE. The KE is 12%. Should Mr. A buy the share? Should he buy or not depends on what is the fair value of the share, which is the next requirement. If so, what is the maximum price should he pay for each share? Assume no tax on dividend income and capital gain. Now I have to exactly do this year cash flow, PVF, DCF, and find out the fair value of the share. Here, no model, nothing needs to be done. Everything is given directly, saying that first year what is the dividend, second year what is the dividend, third year what is the dividend, fourth year dividend, fifth year dividend, sixth year dividend, seventh year dividend, and at the end of seventh year you will sell the share. Selling price is also given in the question. No valuation, nothing needs to be done. You just need to keep writing year cash flow, PVF, DCF, and put a total that will give you the fair value of the share. When we do this, somewhere I'll have to give effect of this 5% incidental expense. What does that? We'll understand. But in this question, it is exactly same as the previous question. We have to do the valuation. One principle of valuation is present value of future cash flow. And here they are saying no need to apply Walter formula, no need to apply Gordon's formula. We give you the price. Every year dividend, I tell you what is the dividend. And at the end of seventh year, I will sell it for 900 rupees. Whether it becomes 900, whether it goes down, goes up, we are not bothered. As of now, this is indicated in the question. Let's start valuation directly. Year cash flow, PVF, DCF. Year cash flow, PVF, DCF. What's the discount rate given? 12%. First year. First year I'll get dividend. Assuming I buy one share, I can buy any number of share. Assuming I bought one share, what's the dividend percentage they're saying? 20% on what we will get? On the face value. On the face value. So 100 into 20%. 20. Second year again 20. Third year again 20. fourth year again 20, then something else happens there. Fourth year again 20. It says at the end of fourth year, a bonus is declared in the ratio of what? 1 is to 5. If they declare bonus in the ratio of 1 is to 5, my one share, assuming fraction is allowed in the practical world, one share will become 1.2 share. One share will become 1.2 shares. Will it exactly become 1.2? No, I would have bought 100 shares. 100 would have become 120. 100 would have become in the practical world 120, or 50 would have become 60. I don't know how many shares we are buying, but assuming it is in one share I purchase, one has become 1.2. The only change is fifth year dividend will be 1.2 into 20 rupees. It is same 20 rupees only, but now I will get dividend income on 1.2 share because my one share has become 1.2 at the end of fourth year. Bonus is declared at the end of fourth year. So fourth year I will not get 1.2 share. Fourth year only 20 rupees. Fifth year 1.2 into 20. 1.2 into 20. Sixth year, seventh year, and at the end of seventh year, I will sell my shares. One problem is whenever I sell or buy, I have to pay some brokerage charges of some 5%. They're saying incidental expense on purchase and sale of share. On purchase and sale of share is what? 5% of the market price. So when I'm selling it, I'll get 5% less. So what is the value I'll get in the seventh year? I'll get 5% less. It's not 855. First, it is 1.2 share. You will be selling 1.2 share, not one share. You will be selling what? 1.2 share, assuming fractions are allowed in the practical world. 1.2 into 900 minus 5%. I don't want to spend time on the discounting part and all. You can just write the total to be 561.14. 561.14. This is the real worth of the share. The real worth of the share is 561.14. The total turns out to be 561.14. Now listen, normally whatever is the real worth is the maximum price I can pay. But here there's a problem. The problem is when I purchase, I have to pay 5% of the market price. So what I can pay, any doubts on first 561? Now below this, right? Purchase price plus 5% of purchase price is equal to 561.14. Purchase price plus 5% of purchase price. Purchase price plus 5% of purchase price equal to 561.14. Listen, in a normal question, 561.14 is equal to maximum purchase price because that is the real worth and I can pay that much for the asset. A car real worth is 561, you can pay 561. But now the dealer is saying whatever price you pay, additional 5% income tax, indirect tax is there. Then I say 561 is equal to price plus 5%. Now tell me the maximum purchase price. Calculate and tell me the maximum. 530. 561.14 divided by 1.05. 534 point. This is the maximum price I can pay for the share, and I will go ahead and buy the share at 500 rupees. 500 rupees I'm very happy to buy. 534 I can pay. I can pay 534.42. 500 rupees, very very happy to make the payment. I can afford to pay 534.42 in this case. Clear? Any doubts on this? Okay, in the printed material that maximum purchase price got missed out there, but take a 534 point. This number is what I can end up paying. Okay. Now there is a small discussion on something called as dividend reinvestment and buyback of share. Whenever a buyback happens, you would have learned this maybe in your accounting. Buyback will reduce the net worth of the company. So whenever a buyback happens, net worth will go down. We are going to see a question: what happens to net worth because of the buyback of share? Let's see this question. Parth Limited had recently repurchased 20,000 equity shares at a premium of 10% to its prevailing market price. Book value per share after repurchases 193.2. Other details is earnings before buyback, current market price with a P ratio of 18. Calculate book value per share of the company before the repurchase. Book value before the repurchase. Before the repurchase means before the buyback. What is the book value per share? Now, book value per share is nothing but net worth divided by number of shares. In this question, how can I calculate how many shares are there before buyback? How many shares before buyback? How can we calculate here? Earnings, MPS, P multiple. P multiple and MPS will give me earnings per share. Earnings per share, overall earnings will help us in giving number of share. Once I get that number of share, earlier so many shares was there. Revised share is 20,000 less, and accordingly will somewhere get to the net worth after buyback, net worth before buyback, and finally book value per share. Working note 1, our computation table, particulars before buyback, after buyback. EAES, number of equity shares, EPS, P multiple, MPS. We will use this to get the number of shares first. EAES, number of equity shares, EPS, P multiple, and MPS. What's the EAES number given in the question? 18 lakh. Number of equity shares is, this is what we are trying to find out. Then other data we had is 270, 18. 270 and 18. EPS will become balancing figure. How much is the EPS number? 15. Number of shares balancing figure. 1,20,000 shares. Now, how many shares did we buy back? So 120 minus 20 is the after buyback shares. Other things I don't want to write because it doesn't make any difference. Then book value per share, net worth. Book value per share and net worth. After buyback, the book value per share is 193.2 and net worth will be 1 lakh into 193.2. 1 crore 93 lakh 20,000. Net worth is 1 crore 93 lakh 20,000. 193.20. Now, in this net worth figure, what will happen is before buyback, the net worth would have been higher. The buyback has happened 20,000 shares into 270 rupees plus extra 10% at a premium of 10% to the prevailing market price, at a premium of 10% to the prevailing market price. So below the table, buyback size 20,000 shares into 270 plus extra 10%. 270 plus extra 10%. How much the buyback size? 59 lakh. And net worth earlier would have been 1 crore 9320 plus 5940. Earlier the net worth would have been higher, number of shares were also higher. 1 crore 93 plus 5940. 2 crore. And earlier book value is 2 crore 52 lakh divided by 1 lakh 20,000 shares. Divided by 1 lakh 20,000, which could be more than 193, less than 193, whatever the number. 2 crore 52 divided by 1 lakh 20,000. 2 to 10.5. So earlier the book value was 210.5. Because of the buyback, this is something you could have seen in accounting. So the book value per share has gone down. Whatever buyback we do, it will go ahead and reduce the net worth of the company. Any doubts on this? Okay. Your material also has something called as a very simple approach called Graham and Dodd model and Lintner's model. Graham and Dodd, a very simple formula. Let's quickly discuss this. RA Limited has earnings of 12 per share this year. Dividend payout is 75%. Multiplier of 7 is considered reasonable under current market condition. What is the likely price under G&D model? Now, Graham and Dodd also focused on dividend and retained earnings, but he gave a different formula. Now, right, price under G&D model is equal to price under Graham and Dodd model is equal to dividend plus earnings by 3. It's not retained earnings, it's earnings by 3. Dividend plus earnings by 3. He did not give a logic for by 3 and all. Dividend plus earnings by 3 into multiplier, like P multiple, something will be there in the question, into multiplier. The only main difference is it's not retained earnings, it's entire earnings by 3. Dividend plus earnings by 3 into multiplier. Dividend number is earnings of 12, payout ratio is 75%. Payout ratio is 75%. Earnings of 12 rupees. So dividend is 9 plus 12 by 3. All other model, it will be retained earnings by 3. When we did Walter, dividend plus retained earning. Here it's dividend plus earning by 3. So your earnings will be counted twice. One in dividend, second in the full earnings itself. Dividend plus earning by 3 into multiplier is 7. How much? 9 plus 12 by 3 into 7. Clear? Any doubts on this? Okay. Now, all other models which we did, like Walter, Gordon, or Graham and Dodd model, everything was focusing on price impact. Lintner model is the only model which focuses exactly on the dividend to be paid. Now, what does the Lintner's model say? Let's quickly discuss this. Last year dividend 9.8, speed of adjustment 45%, target payout ratio 60%, EPS 20. Find out the current year dividend. Find out the current year dividend. There are some 4-5 calculation to be done. Let's write them. Right, last year dividend. Last year dividend. Last year dividend. How much the last year dividend? current year target dividend. Current year target dividend 20 rupees into 60%. 20 into 60%. 12. 20 into 60%. Now, what Lintner said is whenever incomes go up significantly, don't increase dividend significantly, because what shareholder don't like is income dividend going up, going down, going up, going down. So, when suddenly my income increases, my expense should not increase. My income has gone up. Let me increase expenses gradually. In case I have a bad year like COVID, that time my savings will take care of my expenses. So here 9.8 will become 12 rupees, which is like a growth of around 20-25%. Lintner said don't increase it so much. Now, right, target increase. Target increase in dividend 2 rupees 20 paise. This is the target. Looking at the payout ratio, you should increase it by 2.2. Lindner said don't increase so much. Actual increase will be lesser than 2.2. Target, you can afford to increase it by 2.2 looking at the payout ratio. Actual increase 2.2 into some speed of adjustment they would have given. I will increase only this much. I'll not increase it fully. 2.2 into 45%. How much? 0. And next year dividend is equal to 9.8 plus 0.99. 9.8 plus 0.99. The next year dividend will be 9.8 plus 0.99. Rather than increasing it by 2.2, we'll just increase it by 0.99. 10.79. Clear? Last model of valuation, approach. All other models said the share price will get impacted, dividend paid, not paid, high increased dividend, decreased dividend. Modigliani-Miller approach, like we did under the capital structure, said the value of the company will not, share price may change, but value of the company will not be impacted. Let's see this now. MCO Limited has a paid up capital of 10 lakh, face value of 10 each, current market price is 20. Board of Directors has an agenda of meeting to pay a dividend of 25% to its shareholder. Company expects a net income. Net income is profit after tax of 5 lakh 20 at the end of current financial year. Company also plans for a capex for the next financial year 7 lakh 50, which can be financed through retained earning and issue of new equity share. Company's desired rate of investment is 15%. Following the Modigliani-Miller hypothesis, determine value of the company when it does not pay dividend and it does pay dividend. When it does not pay dividend and it does pay dividend. Whether dividend is paid or not paid, approach said the value of the company is going to remain same, whether it is paid or not paid. Today the value of the company is, how many shares are there today? 1 lakh into 20 is the value of the company. We'll calculate the futuristic value and then do something called as adjusted value, because ICI does something called as adjusted value. That value will be again 20 lakh rupees. At the end of the year, the value is going to remain same, 20 lakh rupees. Today the value is 1 lakh into 20. End of the year also it will be 1 lakh into 20, whether dividends paid or not paid. Particulars in 2 columns. Company pays dividend, does not pay dividend. Pays dividend and does not pay dividend. Opening price 20. Cost of equity, opening price 20. Cost of equity, it says company's desired rate of investment is 15%. assuming this is the required return of my shareholder. I do not have any other option. Assuming this is what my shareholder wants, I take this as cost of equity. There's no other information in the question. Desired rate of investment is 15%, assuming this to be the required return of my shareholder. 15%. Cost of equity 15%. Dividend per share. Read the question and tell me what's the dividend we are going to pay. 25% of what? 25% of face value. 25% of face value, which is 10 rupees. If you pay dividend, 10 into 25%. And if you don't pay dividend, 0. Closing price. Now, what Modigliani Miller said is closing price should be equal to 20 plus 15%. See, as a shareholder, I invested 20 rupees in the company. At the end of the year, I want 20 plus extra 15%. This extra 15% is 20 plus 15, 23. This 23 can come in two ways. Dividend of 0, price of 23. Dividend of 1 rupee, price of 22. Dividend of 2 rupees, price of 21. Dividend of 10 rupees, price of 13 rupees. I want 23 rupees. In what form you give doesn't really matter. So closing price is equal to, you can write the formula, P naught into 1 plus KE minus D1 minus dividend. In case dividend is there, price can be little lesser. Dividend not there, price has to be on the higher side. 20 into 1 plus 0.15, 2.5. 20.5 and 23. Closing price 20.5 and 23. Clear? This is one part of the calculation. Price may change, but the value is going to remain same. Next, total earnings. Somewhere the total earnings would have been given in the question. How much profit they are going to make? 5,20,000. Dividends paid 1 lakh shares into 2.5. 1 lakh shares are there into 2.5. Total earnings, dividends paid, retained earnings. Total earnings, dividends paid, retained earnings. Two lakh 70,000, 5,20,000. Now what MM said is, if you pay dividend, anyway you have to do some investments. I have to do an investment of 7,50,000. If I have to do investment of 7,50,000, whatever balance money after retained earnings, I'll have to issue fresh shares. So here, right, capital expenditure 7,50,000. Fresh issue of equity. If you pay dividend, you will now issue more shares and more money is needed. So here 4,80,000 has to be raised. From 7,50,000, I have only 2,70,000 with me. And here from 7,50,000, 5,20,000. So if I don't pay dividend, I collect less money back from my shareholder. I pay dividend and I collect more money from the shareholder. MM said, what is the point of paying dividend or not paying dividend? So he ultimately concluded, if you pay dividend, you will collect more. Next, closing price 20.5, 23. Shares to be issued. Shares to be issued. Shares to be issued. 4,80,000 divide by 20.5. 4,80,000 divide by 20.5. 23,415. 2,30,000 by 23 is 10,000. I pay dividend, collect money back again in the form of equity. I don't pay dividend, collect lesser money only, because anyway I need money for doing capital investments. Finally, closing shares. Originally we had 1 lakh shares, now 1 lakh plus extra. Closing value of firm. Closing shares into closing price. Closing value of firm. Both will be same. Rounding of differences can be there. Now ICA doesn't write this alone. They write something called as an adjusted value, but value is same. Value is same. This is what we had to. The question wanted us to calculate what is the value of the company when it does not pay dividend. It does pay dividend. This is closing value, but there's an adjusted value is what ICA writes. Any doubts on this? 2530 and 2530 both are same. That 8 rupees is rounding of difference. Then closing value of firm adjusted. 25 lakh 30,008. 25 lakh 30,008. In this, they make an adjustment. See, it will has to go back to that 20 lakh number which is there originally. It has to go back to that 20 lakh number which is there originally. Capex deducted, whatever capex we do, 750, and whatever profits we earn, divide by 1 plus KE. Divide by 1 plus KE. It will go back to original 20 lakh. It will go back to original 20 lakh rupees. Whatever capex we did, whatever, I really don't feel a need to do this adjustment, but ICA it does it. So let's write it. Assuming capex did not happen, I reverse the capex, and profits are not earned, we reverse that as well. Clear? So the value is same, and then we do this adjustment. Closing shares into closing price minus investment plus earning divided by 1 plus K, same 20 lakh we get for both the situation. Any doubts on this? With this, the dividend decision chapter is almost over. I will discuss this question 12. You need not do it. You can just refer the screen when I'm doing it. This is a slightly a reverse working kind of a question. Ordinary shares of a listed company are currently trading at 10 per share with 2 lakh shares outstanding. Company anticipate earnings next year will be 5 lakh. Existing cost of capital is 15%. Company has certain investment proposal under discussion which will cause an additional 26,089 ordinary shares to be issued if no dividend is paid, and 47,619 shares to be issued if dividend is paid. Calculate the amount of investment and the dividend that is under consideration by the company. Almost same question, just that it will take a lot of time at your end. I will have to repeat the same table. You look at the question and tell me the values alone. The same table we are going to repeat again. What is the opening price? Look at the question and tell me the opening price. First line, trading at 10 per share, currently trading at 10 per share. I don't want you to solve it, be in lesson mode. 10 per share. What is the cost of equity? 15%. I don't know this as of now, we'll see later. Dividend per share we don't know as of now. That's one of the requirement. This side 0, this side it is 0. We will not know the closing price. Here the closing price is 10 plus 15% minus 0, minus 0. So this is 11.5. This is 11.5. Have they given total earnings of the company? Dividends paid, I don't know. This is 0 here. This side it is 0. Retained earnings is 5 lakh. Capex is something which we have to calculate. We don't know the capital expenditure number. Fresh issue of equity, I don't know. Closing price is 11.5. Shares to be issued is given in the question. If you do not pay dividend, how many shares are issued? No. No dividend is paid is 26,089. No dividend paid is 26,089. 47,000 if dividend is paid by the company. So now what I can do is fresh issue is 11.5 into 26,089. 11.5 into 26,089. 11.50 into 26,089. Clear? Able to understand this? 11.5 into 26,089. Tell me the value. Fresh issue of equity. 3 lakh 23. Sorry, 23. 23. And in the reverse order, I'll get my, sorry. Okay, sorry. 3 lakh 23. 3 lakh 23. And in the reverse order, my capital expenditure is 7 lakh 23. 8 lakh 23. Capital expenditure is 8 lakh 23 in the reverse order. So one of the requirement was to calculate capital expenditure. We are done with that. 8 lakh 23. This side I get 8 lakh 23. I get 8 lakh 23. So one of the requirement was to calculate capital expenditure. We are done with that capital requirement. I'll explain again. 11.5 is my closing price. 11.5 into 26,089 is my fresh issue of equity share, and my capital expenditure will be retained earnings plus the fresh issue of equity share. Once this is done, I can say closing. How many shares are there opening? How many opening shares are there? 2 lakh plus 26,089. 226089, and closing value is 226089 into 11.5 into 11.5. In the printed material, I've done it in a longer form. This is slightly easier form. 226089 into 11.5. 26 lakh 024. And what I can find is closing prices this side, same 26 lakh 24 should continue. It could be 26 lakh rupees, some up and down can be there. Same value will continue. Same value will continue, and this will tell me this side closing share is 2 lakh plus 47,619. This side it is 47,619. Can you please reverse work and tell me what is the closing price? Please tell me this price now. Reverse working. Closing value divided by closing shares. Closing value divided by closing shares. 10.50, and 10.50 will give me the dividend per share. How will it give dividend per share? Is the closing price is equal to opening price plus the cost of equity minus the dividend paid. Closing price is equal to other things, I don't need it in the table. So my closing price is equal to opening price into 1 plus KE minus D1. 1 plus KE minus D1. 10.5 is equal to 10. Tell me the D1 number. This will give you the dividend number. You get dividend of 1. Any doubts on this? This is what I've presented in the printed material, but I've taken little longer calculation. This is an easier one. Just do it in the table approach itself. You'll get to the answer. Dividend is 1 rupee and capex is 8,24,000. Be very clear on the interlinkages. Every item, if you're clear on the interlinkage, it will automatically happen. Any doubts on this? Clear? With this, my dividend decision chapter gets over. I take a break of 10 minutes and then we start with ratio analysis. Okay, so we are done with the entire first block which I wanted to discuss. So the cost of capital, capital structure, leverages and dividends put together around 27 mark of discussion out of the 65 marks of paper. Then second part is your theory segment, which is a 10 mark segment. In the chapter 1 and 2 alone will be 7 marks and other chapters could be 3-4 marks on an average. So that is the next thing, you will have to do 100% theory completion, which is approximately 10 pages, 10 to 11 pages of theory. You should spend time and close that. Then comes ratio analysis, working capital and investment decision. Ratio analysis will do it fully. In ratio analysis, I will not have any link between question 1, question 2, question 3, question 4. I can randomly pick any question and do. Only thing is you will have to be aware of all the ratios. That is where I had told you earlier to spend some time and be very clear on the various ratios which are there. I'll directly get into questions again. Let's come to, and there are a lot of good MCQs also in this area. Even MCQ solving will give you a lot of comfort here. This is one chapter, leverages, and this chapter is here heavily MCQ dependent. With MCQ itself, you can get good understanding. Let's come to question 1. Team Limited provides you the following information. Okay, go through the question first. Question 1, page 82. Okay, I'll start discussing it. Debt figure is given with interest rate given. This can help me in calculating interest amount. Debt to equity ratio. Debt is there. I can get equity with this debt to equity ratio. Return on shareholders fund. This is called return on equity. What is the formula for return on equity? Participate, return on equity. EAES divided by amount of equity, or PAT by amount of equity. So I'll get the profit after tax. From profit after tax, with the tax rate, we will get profit before tax. With profit before tax and interest, we will go back and get EBIT. With profit before tax and interest, we will get EBIT. Operating ratio. What is operating ratio? Is operating expenses plus COGS divided by sales. Operating expenses plus COGS divided by sales. In that, OPEX is 2 times, COGS is 6 times. Fixed assets is given, current ratio has been given. I have to calculate interest coverage. What is the formula for interest coverage ratio? EBIT by interest. Coverage ratio is what is the source of making the payment divided by what are we making, source of making the payment divided by what are we paying. So interest is paid out of EBIT. GP ratios are, GP ratio is GP by sales. I will not have GP and all here. GP ratio can be called as 100 minus COGS. 100 minus COGS. And how will I get COGS? Using this understanding here, OPEX to COGS, and current assets have been asked in the question. Let's start. Working note 1. Computation of interest coverage ratio. Interest coverage ratio. Debt by equity is equal to, debt by equity is equal to 1.5 by 1. 1.5 by 1. You know the debt figure, you will get equity as balancing figure. 1.5 by 1 was the debt figure in the question. 45 lakh by equity is equal to 1.5 by 1. Equity is equal to 30 lakh. Equity is 30 lakh. Clear? Next, ROE is equal to PAT, no preference dividend at all here, PAT by equity. ROE is equal to PAT by equity. It's EAES by equity, but here it's profit after tax. PAT by equity. What's the ROE number? 54% is equal to PAT by 30 lakh. PAT equal to 16 lakh 20. PAT equal to 1620. PAT equal to 16 lakh 20. PBT equal to, from PAT, if I want to get PBT, I have to divide by what? 1 minus tax rate. Divided by 1 minus tax rate. What is the tax rate? How much? 60,000. And from PBT, if I add interest, I'll get EBIT. From PBT, if I add interest, I'll get EBIT. So directly now interest coverage ratio is equal to, interest coverage ratio is equal to EBIT by interest. EBIT by interest, 2160 plus. Interest is 45 lakh into 12.5%. 45 lakh into 12.5%. How much? 5 lakh divided by 562 500. You will get the interest coverage ratio. 2160 plus 562 500 divide by 562 500. 4.84 times. This is on the interest coverage ratio. Interest coverage ratio is 4.84 times. Clear? Any doubts on this? Working note 2. Computation of GP margin. GP margin. COGS plus operating expenses. COGS plus operating expenses is equal to, COGS plus operating expenses is equal to, they said operating ratio 85%. So both put together is 85%. COGS plus operating expense is equal to 85% of sales. 85% of sales. COGS and operating expenses 85% of sales. In that, ratio of operating expense and COGS is 2:6. So OPEX, operating expenses and COGS ratio is 2:6. Split 85 in the ratio of 2:6 and tell me what is COGS. 85 in the ratio of 2:6 and tell me the COGS part alone. 85 split in the ratio of 2:6. 63.75% of sales. GP is 100 minus 63.75%. GP is 100 minus 63 point. We don't know the sales figure and all. We'll not get it. GP margin is 100 minus the COGS. Operating ratio is 85%. So 85% of sales. 85% of sales. OPEX plus COGS. OPEX plus COGS put together is 85%. Breakup is 2:6. Breakup is 2:6. GP margin is equal to 100 minus 63.75. How much? 36.25% of sales. So GP margin technically 36.25% of sales is not needed. This is the GP margin 36.25%. Clear? Working note 3. Computation of current ratio. So current assets, current ratio is given, current assets. Computation of current assets. Now, if I visualize the balance sheet of the company, it will be equity, debt, fixed assets, current assets, current liability. I know the total of this. Hence, the concept says this is called capital employed. The total of this is equal to fixed assets plus current asset minus current liability. The total of equity and debt, which is called capital employed, is equal to fixed assets plus current assets minus current liability. Or it is equal to fixed assets plus working capital plus working capital. Once I get the working capital figure, I'll be able to break it into current assets and current liability. Next, right? Capital employed is equal to capital employed. This is just known in exam, no need to write this way, but this is just to tell you there are two formulas for capital employed. One formula is equity plus debt plus technically preference. Preference is not there. Equity plus debt is equal to fixed assets plus current assets minus current liabilities. Fixed assets plus current assets minus current liabilities. What's the equity figure? 30 lakh. Debt figure? Fixed assets is given in the question. Plus working capital. You will get the working capital figure. Working capital. This will give you the working capital. Working capital is then current assets minus current liabilities 36 lakh. Current assets minus current liabilities 36 lakh. 36 lakh. In that, current ratio is 1.8, which means current asset is 1.8 times of current liability. Current asset is 1.8 times. This is a usual ratio adjustment in balance sheet preparation. 1.8 CL minus CL is equal to 36 lakh. This will give you current liability. Then we will get current asset. 1.8 times of current liability minus current liability is 36 lakh. is 36 lakh. Get me the current liability figure. 45 lakh. Current assets is equal to 45 lakh into 1.8. A very good question. Any doubts on this? Can you proceed? 81 lakh. Current asset figure is 81 lakh. Go through question 2, a slightly lengthy problem. Quickly read through it. Okay, I'll start explaining. There's a P&L given in the question, which has some of the information which I would need. Balance sheet is given in the question, and then following are the standards for the upcoming year. All the figures are based on closing figures in the financial statements. So this is not sure which is the past data or futuristic data, but they have given two numbers. Equity share capital to reserves will be 1 time. Net profit ratio 15%. GP ratio 50%. Long term debt to equity 0.5. Debtors turnover 100 days. Creditors turnover 100 days. And inventory 70% of opening inventory. So this is the next year data. First, they want inventory turnover ratio in days for current year. For current year is this year data, and receivables turnover ratio in days for current year. Inventory turnover ratio is COGS by average stock or closing stock. If you want in days, inverse into 365. You have to inverse the formula and do into 365. Now write inventory turnover ratio in days. Inventory turnover ratio in days. Inventory days is equal to closing stock by COGS into 365. Inverse formula, closing stock by COGS into 365. We will take it from the balance sheet. All this information from the last year data. What is the closing stock in the balance sheet? 38 lakh 60,000. 38 lakh 60,000. COGS 76 lakh 40,000 into 365. We can do 360 also. 184 days of inventory we are maintaining. Inventory days 184 days. If inventory ratios are COGS by average stock, closing stock, depending on the data. Now one rule of ratio analysis is wherever you take a ratio which has P&L and a balance sheet item. For example, this is a balance sheet item. and the denominator is a P and L item. Ideally for balance sheet you take average. For the balance sheet item you should take average, whichever ratio we follow. For example, current ratio, no average is needed because current asset balance sheet, current liability balance sheet. If you do GP ratio, no average needed. GP is P and L item, sales is also P and L item. But one P and L item, one balance sheet item, ideally for the balance sheet item you need to take average wherever data is available, because balance sheet is as on date figure, P and L is for the year figure, to ensure little bit of consistency or to avoid, because at the end of the year suddenly the figure could be huge up or huge down. We take average for the balance sheet item. Next ratio they've asked us, receivables turnover ratio, receivable days, receivable days, receivable days, debtors turnover ratio. What is the formula for debtors turnover ratio? Credit sales by average debtor, inverse formula. Debtors by credit sales into 365. Debtors by credit sales into 365. Debtors from the balance sheet, 3997, 1 crore 25 lakh. We do not have a separate breakup of cash and credit sale, into 365. $117 days. Clear? Next requirements are projected receivable, inventory, payable and long-term debt. Projected in receivable, inventory, payable and long-term debt. Now for projected receivable, I will need the sales figure. Now to get to the sales figure, we'll have to see certain information. Equity share capital to reserves is 1 time. What is the use of this information? Today, 30 lakh, 18 lakh. Equity capital can never go up unless they give data, which means reserves is going up from 18 to 30. Indirectly, profit for the next year. Profit for the next year is given. From the profit for the next year, I'll use the NP margin and I'll get the sales number. From the profit for the next year, I'll get the sales number. After I get the sales number, sales into 100 by 365 is the receivable figure. 100 by 365 is the receivable figure. And from the sales, we will get COGS. COGS into 100 by 365 is creditors, because creditors is based on COGS in the question. Creditors is based on COGS. Inventory, no big problem. Inventory, they have said 70% of opening inventory. You know the opening inventory, based on that you get. Long-term debt to equity is 0.5. This will help us in getting the long-term debt figure. Long-term debt to equity is 0.5. Now right, next year analysis. Next year analysis. Share capital to reserves. Share capital to reserves is equal to 1:1. 1:1, 1 time. Closing share capital 30 lakh. Whatever is the opening will become closing share capital. It is not going to go up, not going to go down. Closing share capital 30 lakh. Closing reserves 30 lakh. Closing reserves is 30 lakh. Every information is critical, and now what I can say is opening reserves is 18 lakh, closing reserves is 30 lakh. The one thing is, in ratio analysis, any question you do, if you keep doing with me, you will keep getting the answer, you will understand everything, it will not be very difficult. Only when you do on your own, every question will have its own set of challenges. So that is the only challenge here. The same question, even if you repeat practice again, it will give you the much needed confidence to face the exam, because every question We'll have some unique adjustments here and there. So closing reserves is there. Increase in reserves in bracket profit of next year. 30 lakh minus 18 lakh. And one more thing, based on assumption, answers can change and a lot of assumption based area will be there. 12 lakh is the increase in reserves. Net profit equal to they have given the net profit ratio 15% of sales. 12 lakh equal to 15% of sales. Tell me the sales figure. 12 lakh equal to 15% of sales. How much? Debtors equal to sales into 100 by 365. 100 by 365. We are taking 365. We can take 360 also, but we are taking 365. 100 by 365. 80 into 100 by 365. 21 lakh 91,781. Clear? I think I am kind of done. You keep doing it. Refer the screen if you want. I've already explained other things. Debtors is what I wanted to get. Listen, they've asked for projected receivable done. Inventory 70% of opening inventory. Payables COGS into 100 by 365. Long term debt is 0.5 of equity. 0.5 of equity. You keep doing it. Refer the screen. Once you are done, in case you get a doubt, refer the screen. The equity would mean share capital as well as reserves. Okay, that you will have to be careful. Let me know in case any doubts, any calculation errors you spot. I'll wait for a minute and then I proceed. This is one segment where a lot of practice at your end is what is going to help ultimately. We can keep doing question, but ultimately what will help in exam is your practice. Can you proceed? Any doubts on this? Done? Let's come to this. A slightly small question. Let's quickly discuss it. You are required to calculate the total current asset of Ananya Limited from the given information. Stock turnover 5 times, sales all credit, GP ratio, current liability, liquidity ratio, stock at the end is 30,000 more than the stock in the beginning. Liquidity ratio means what? What is the liquidity ratio meaning? Quick ratio, which is quick assets by current liability. What is quick assets? Is all assets other than inventory. So this will give me quick asset figure and I just need inventory figure. How will I get inventories? Using stock turnover. Stock turnover will give me the average stock. Why average? Because they're saying stock at the end is 30,000 more than the stock in the beginning. So I'll get the average and from the average I'll get the closing stock. I'll get the closing stock. So write note 1, computation of quick assets. Computation of quick assets. Quick assets. Liquidity ratio is equal to quick assets by current liability. Liquidity ratio is equal to quick assets by current liability. Quick assets by current liabilities. Quick asset figure is, now I just need inventory figure. With the quick asset, I add the inventory figure, I'll get the total current asset. Next, computation of closing stock. Computation of closing stock. We have sales, we have GP margin. With that, we will get COGS. Once COGS is done, COGS by average stock is stock turnover ratio. That will give you average. From average, you have to get opening and closing. So now write GP margin is GP is equal to 25% of sales. GP is 25% of sales. COGS is 75% of sales. COGS is 75% of sales. Five lakh 40. COGS 5 lakh 40. Stock turnover is equal to COGS by average stock. If information was not there, I can take this as closing, but there is information to get opening and closing. 5 is equal to 5 lakh 40 by average stock. Average stock is how much? 108. Now this average needs to be bifurcated into opening and closing. It says closing is 30,000 more than the opening. Closing is 30,000 more than the opening. So right, opening stock A, closing stock A plus 30,000. Average of this is 1,08,000. That will give you opening. Closing is 30,000 more. Closing is 30,000 more. A plus 30,000 divided by 2. Opening and closing is equal to 1,08,000. A plus 30,000 by 2 is equal to 1,08,000. What is the figure for A? 90. Closing stock is equal to 93 plus 30. And total current assets is equal to 3 lakh plus 123. 3 lakh plus 123. Clear? Done? Let's come to this. Go through the question, slightly lengthier one. Go through it first. Okay, they've given multiple ratio: current, loan funds to own funds, return on total assets pre-tax, GP ratio, stock turnover, current market price, net working capital. I'm being asked to calculate quick ratio, fixed asset turnover ratio, debt service coverage ratio, earnings per share, and price earning ratio. Ratios will need certain assumptions. I don't want to deviate the solution, so assumption area I'm written here. Preference capital to be part of owners funds. This is an assumption based area. Preference can be part of equity, can be part of borrowing. There's one ratio where it's always part of borrowing called capital gearing ratio. Return on assets pre-tax is to be based on, this is little tricky. It should not be based on EBIT. It should ideally be based on PBT. But solution has taken it on EBIT, so I've written it as on EBIT. You will not be able to exactly do it on EBIT in exam. If it comes in exam, you will do it only on PBT. This is just to ensure that I get the same answer which is there in the printed method. Otherwise, I'll say my answer is different, I say answer is different. That is why I've written these notes. But in an exam situation, if you give me this question, this is okay. Second part, I am 100% sure I will do only on PBT. I am not going to do it on EBIT, but the question has said, the solution has done it on EBIT, so I have written a note here. Third is DSCR can be based on PAT. There are two formulas for DSCR. One is called fixed charges coverage ratio. Another called as DSCR. DSCR is the debt service coverage ratio. PAT, add back depreciation, add back interest divided. Here they are saying do it on the basis of pre-tax cash profit. What is pre-tax is? Do it on the EBIT. Do it on the EBIT. So these are the three assumptions we are taking. First is quick ratio. For quick ratio, I have current ratio, I have net working capital. This combination will give me current assets and current liability. From the current assets, I have to remove stock. I have to remove stock. For removing stock, somewhere we will have to use the stock turnover ratio and try to get to that number. How are we going to get to that number? We'll see, but somehow I'll have to use that number. Working note 1, computation of current assets and current liability. Note 1, computation of current assets and current liabilities. Current assets and current liabilities. Working capital is equal to, how much is the working capital given? 5 lakh. Current asset minus current liability is 5 lakh. Current asset minus current liability is 5 lakh. In that, the current asset is 3 times of current liability, 3 is to 1. Current ratio is 3 is to 1. 3 CL minus CL is equal to 5 lakh. 250 and 750. Current liability and current asset 2 lakh 50 and 7 lakh 50. Clear? Any doubts on this? Then somehow I'll have to get to the sales figure. Tell me which ratio can help me in getting sales figure. One ratio will help us in getting the sales figure. Total asset turnover ratio. Fixed assets plus current asset is total asset, and total asset turnover ratio can give me the sales figure. From sales I will get COGS. From COGS I'll get the stock. Close the first ratio, which is quick ratio. We'll close that ratio, and fixed asset turnover also will get over with that once you get the sales figure. Next, note 2, computation of sales. Computation of sales. Total asset turnover ratio is equal to sales by total assets. How much the total asset turnover ratio? 2.5 is equal to sales by 15 lakh plus 7 lakh 50. Get the sales figure. $56 lakh 25,000. COGS is equal to sales is 56.25. Any doubts on this? What is the GP margin given? COGS is 75% of sales. (75% into 56.25). 42. Now I will use the stock turnover, that will give me average stock. Why average? Because the opening stock is given in the question, so I'll get the closing stock later. Opening stock is given in the question, 650, 500. Question has given opening stock, we'll get the closing as balancing figure like the previous question. Next, stock turnover ratio is equal to COGS by average stock, 10 equal to 42, 18, 750 by average stock. 421, 875. A very good question. Lot of adjustments are there. Kind of revises lot of ratios which we have to discuss. Opening plus closing by 2 is 421. Opening is given in the question. Opening plus closing by 2. opening plus closing by 2, 421, 875. Opening is 650, 500. Closing is balancing figure. 1. Please now calculate quick ratio. From the current assets, remove the stock figure. Calculate the quick ratio. From the current assets, remove the stock figure. Till this point, none of those assumptions are critical, but at some stage, I need those assumptions to be taken into consideration. Quick ratio is equal to quick assets by current liabilities, 7 lakh 50 minus 193 250 divided by 2 lakh 50. Sorry, 2275. 7, okay. 227 times. Any doubts in this? Close fixed asset turnover ratio, which is straightforward. Fixed asset turnover ratio, straightforward. We have all the figures now. Sales by fixed assets. Fixed asset turnover ratio. Fifty-six 25 by 15 lakh. 3.75 times. Clear? Third ratio is debt service coverage ratio. For debt service coverage ratio, ICI solution has taken that, do it on EBIT base, that is pre-tax cash profit. What is pre-tax cash profit? Is EBIT plus depreciation. EBIT plus depreciation. In EBIT, interest is not subtracted. Add back depreciation. How will I get EBIT? Again, EBIT is based on return on total asset pre-tax. This is giving EBIT number, is what the solution says. Now, right, return on total asset is equal to EBIT by total asset. It is not ideally EBIT, it is EBT, but solution has said EBIT. This is what the assumption area is saying. We'll see later in case I have written some error there, something. Return on asset 15% is equal to EBIT by total asset was 22 lakh 50. Get the EBIT number. Ideally, this will be EBT number, okay? Any other question, I'll call this as EBT. This question, I'm calling it as EBIT. 33. Now, in the EBIT number, I have to add back depreciation and divide for interest and principal. For interest, I will need debt figure because they have given the interest rate 9%. But debt figure is not given in the question. We will use this ratio. Loan fund to own fund. Loan fund to own fund ratio, and try to calculate something called as your debt figure. Debt figure will be calculated this. Next, computation of debt. Computation of debt. Loan funds to own funds. Loan to own funds 1 by 3. 1 by 3. 1 by 3. Now, in order to calculate this, I need a little bit more calculation to be done. Now, leave this for a time being and come down. Capital employed is equal to fixed assets plus current assets minus current liability. Fixed assets plus current assets minus current liability. What is the fixed asset figure? 15 lakh. Current asset figure? Current liability figure? Capital employed is from this 20 lakh, loan fund is one time, own fund is three times. Loan fund is one time and own fund is equity, preference, and reserves and surplus. I do not have the reserves and surplus data, so that is why I did not use this directly. No other option was there. Zero reserves, and we would have added these two figures. So 1:3. What is the breakup? Loan is clear. In case again I'm repeating, this is a highly assumption based area. Answers can change based on assumption. And ICI is not wrong. Practical world, different banks itself use different ratios and the formula is different. So I used to work in a rating agency. We used to take a formula little differently. Some other rating agency used to take it little differently. So practical angle also, the ratio can be altered according to our requirement. Now write DSCR is equal to EBIT plus depreciation. What is DSCR is, if you take interest coverage, it's only EBIT by interest. Here interest and principal. Interest plus principal. Interest plus principal. EBIT was I think 337. Depreciation is given in the question. Interest is 5 lakh into 9% and principal repayment is given in the question. Principal repayment, last line, future installment 2 lakh. Solution may match, may not match, but let's do it. One point 1.58 times. Clear? Earnings per share and price earning ratio. I have the EBIT figure. From EBIT, I deduct interest, EBT, deduct tax. I'm not going to do that. EBIT, we have 337,500. I'm kind of done with the question. I will not spend time beyond this. EBIT 337,500. Interest, you know the figure. Get the EBT, deduct tax, get the EAT, less preference dividend, get EAES, divide by number of equity share, you will get earnings per share. MPS is given in the question somewhere. MPS will be there. Is the price given? Where is it? Okay, current market price 20. So current market price by EPS is P multiple. Let's see in case they have deviated any of the answer. 7 lakh 50, 5625, 193, 15 lakh. Okay. So EBIT number is 337,500. EBIT number is 337,500. Quick ratio matches, fixed asset turnover ratio matches. We did not do EPS ratio, but EPS is PAT minus preference dividend divided by number of equity share. Price earning ratio I did not do. Debt service coverage ratio, EBIT plus depreciation, interest plus principal. What can be the other formula? The logical formula for debt service coverage ratio is PAT plus depreciation. PAT plus depreciation plus interest, because interest has to be added back, divided by denominator same, interest plus principal. One area where we are deviating is this formula also. Return on total asset is taken as EBIT by total asset. It should have been taken as EBT by total asset. It should have been taken as EBT by total asset. Can you write exactly the same answer in exam? Very difficult, because you will not know what assumption to take. Normally we take it as EBT by total asset. Why I have done in the class this way? Just to ensure that our printed material answer and what I discuss matches. Clear? Any doubts on this? Go through the next question. Go through, it's an MCQ based one. Go through question 5. Okay, there's a balance sheet given. Below some information have been given. 360 days. We'll go item by item. Liquid ratio. I'm not discussing the formula. You know the formula. Give me the answer. Write in your notebook. Balance sheet is there. No extra analysis. Direct answer. Liquid ratio. Write in your notebook and get me the answer. There's no extra analysis. Nothing tricky. No hidden adjustment. 2.33 times. Okay, let me check. Quick assets. This is the total 22 plus 25 plus 30. 22 plus 25 plus 30. Current liability, this is the total 10 plus 15 plus 5 plus 3. 10 plus 15 plus 5 plus 3. Quick assets total is 77. Current liability total is 33. 2 point. Okay, next, what is the sales to proprietary ratio and interest coverage ratio? Now, this is little tricky. Sales to proprietary will ideally mean sales to proprietor funds. Proprietor means owner. In the owner funds, I can include preference. I may not include preference. So let me not touch sales to proprietary first. Let's do interest coverage. Whenever question asks multiple things, don't try to do everything. Just do one of them. With that itself, you can put a tick mark. If not possible, then we will attempt the second ratio. Otherwise, with one ratio itself, I can complete the question. This is another thing which you need to do in MCQ. Don't try end up calculating everything. There are sales to proprietary. I can do sales to proprietary, but I want to park it for the time being because assumption based answer can change. Let's try interest coverage. Now, interest coverage, right? Interest coverage is equal to EBIT by interest. EBIT by interest. EBT is given in the question. Net profit before tax. 20,000 plus interest divided by interest. 20,000 is net income before tax. Net income before tax. Tell me the interest amount. 20,000 plus 4,000 divided by 4,000. 20,000 plus 4,000 divided by 4,000. How much? 6 times. With that itself, I'll put the tick mark for option A. No need to do sales to proprietary. Anyway, now I can discuss. I know the answer is 0.5, which means there are two formula possible. What is sales to proprietaries? 1 lakh divided by total of all the three or total of 1 and 2. Total. Preference can be part, may not be a part. Depends on assumption. That is why I said I don't want to touch the sales to proprietary ratio. In case it comes as descriptive, then take assumption and proceed ahead. There I don't have a choice. But here, at least I can decide which formula to use. And sales to proprietary, I didn't want to touch because assumption based answer can change. Sales to proprietary is 1 lakh divided by 1 lakh plus 80 plus 20 plus 80 plus 20. So my answer is this first one. What is the debtor and creditor turnover ratio? Now, debtor turnover ratio I can do and creditor turnover ratio I can do. Creditor turnover easy because they have given creditor days. What is creditor days? Inverse of creditor turnover ratio. Inverse of creditor turnover ratio. Now write creditor turnover ratio is equal to 360 divided by creditor days. It can be 365 by creditor days. Here question says 360. 360 by creditor days. Inverse of creditor days. How much is the creditor days? So 6 times. With this, I'll not be able to put a tick now. So now I'll have to do debtor turnover ratio. I'll not be able to select the answer. 6 times, easy to do, I've done, but I'll not be able to select the final answer. Reason is because I have two options with 6 times. Calculate debtor turnover ratio. Sales by debtors. debtor turnover ratio, which is also easy only. Sales by debtor. 3 point. Now I can put a tick. 3.33 and 6 times. 3.33 and 6 times. In case I was able to put a tick earlier, I will not do debtor turnover ratio. I will not do debtor turnover ratio. I'll just put a tick for 6 times and then proceed ahead. But I had two options with 6 times, so no choice. In fact, here, if you do debtor turnover ratio first, no need to do creditor turnover ratio, because debtor turnover ratio 3.33, you put a tick and then proceed ahead. That's all. I'll not do the creditor turnover ratio. I thought creditor is easy to do. I did that first. Then I did the next one. Working capital turnover ratio, right? Working capital turnover ratio is equal to sales by working capital. Sales by working capital. Sales is 1 lakh. Tell me the working capital, current asset minus current liability. $94. Divide and tell me the ratio. 1.06. 1.06 times. Those two assumptions I've written there. One is proprietary fund will include preference capital. This was needed for the first one. What is ROI? Now listen, ROI normal formula is EBIT by capital employed. ROI can be pre-tax, can be post-tax. But what ICA has done is ROI based on the total return which would be received by both equity and preference shareholder. One is ROE, which is only for equity. ROI is for ideally debt, equity and preference. In this solution they have taken based on the return which will be received only by who? Equity and preference shareholder. Now write ROI is equal to PAT by equity plus preference. PAT by equity plus preference. This is specific to this question, okay? ROI based on what? Profit after tax. Why profit after tax? This goes to both the guys, equity guy and preference. If you deduct preference dividend, then it is ROE. Then it is ROE. If you add interest also, then it is return on capital employed. Technically, that is the right formula for ROI, EBIT by capital employed. EBIT, certain question we can't help it much. So this is what assumption they have taken. PAT number is from 20,000 deduct tax. From 20,000, net income before tax is 20,000. 20,000 minus 30%, and equity plus preferences 1 lakh plus 80 plus 20. If I don't take this assumption, the MCQ options will not match, okay? If you do the normal formula, EBIT by capital employed, it will not match. So the answer you get is 7%. Normal formula is EBIT by capital employed. That formula will not give me the answer here. Okay, question 6, very simple question, but again an important concept gets discussed here. Net working capital, fixed assets to proprietor fund, working capital turnover ratio, return on equity, there is no debt capital, you are required to calculate proprietor fund, fixed assets and net profit ratio. This is one of the common adjustments we normally do. Now, what is proprietor fund? Is owner's funds. Proprietor fund is asked, fixed assets is asked, net profit ratio is asked. Which ratio should I start with? Very limited information. Which ratio should I start? Now, this is the combination I'm talking about. In this only, we will have this two together will help me in calculating fixed assets and proprietor fund in many questions. Now, right, fixed assets by proprietor fund is equal to 0.75. Fixed asset is equal to 0.75 proprietor funds. Fixed asset is equal to 0.75 proprietor funds. 0.75 proprietor funds. What is the use of this? You will have to use technically this formula. Capital employed is equal to capital employed. Listen, equity plus debt equal to fixed assets plus current asset minus current liability. So let's do this. Capital employed is equal to capital employed, right? Capital employed equal to capital employed. Capital employed is proprietor funds. No debt in this question. Proprietor funds is equal to fixed assets plus working capital. Fixed assets plus working capital. Proprietor funds is equal to fixed assets plus working capital. 0.75 proprietor fund. Working capital is given in the question. 12 lakh. Get the proprietor fund figure. Proprietor funds is this is a very common adjustment. No debt capital is given in the question. Even if it was not given, I would have made that assumption that there is no debt in the company. So proprietor fund is done, then fixed assets. 36 lakhs. Net profit ratio is net profit by sales. Tell me, how can I get net profit here? Again, done today we have done that adjustment. How will I get it? Using ROE. How will I get sales? Using working capital turnover ratio. Next, working capital turnover ratio is equal to sales by working capital. Sales is 60 lakh. ROE equal to PAT by proprietor funds. PAT by proprietor funds. ROE number is 15% equal to PAT by 48 lakh. Seven lakh 20, and you get NP margin. PAT by sales. How much you get? 12%. So fairly straightforward. The proprietor fund adjustment is a common adjustment which we'll do in few questions, and we have already done that in the first question which we did today. Clear? Okay. Now for ROE calculation, what we do is a very simple formula called as PAT by equity. DuPont framework is there which says you'll have to expand this formula a little further and then do the calculation. Let's see this in this question. A limited company's books reveal the following information: net income, shareholders equity, asset turnover, net profit margin. You are required to calculate ROE based on DuPont model. Now write ROE is equal to PAT by equity. Then he said, no, don't write it like this, expand it. PAT by sales into sales by asset into asset by equity. This is what DuPont said. PAT by sales, sales by asset, asset by equity. PAT by sales is called NP margin. Sales by asset is called asset turnover, and this is technically called equity multiplier. I can directly also get PAT by equity, but DuPont said break it into three and then write PAT by sales, sales by asset, asset by equity. NP margin is given in the question 12%. 12%. See, what is ROE? 360 by 4 lakh, direct answer. That is the final answer, 360 by 4 lakh. But instead of writing it that way, we have to write it in a roundabout manner. Asset turnover 2.5. What is equity multiplier? Is asset divided by equity. I know the equity figure. How will I get the asset figure here? I need the asset figure. First, we will get sales, then we will get asset. Now, write below the table NP margin. NP equal to 12% of sales. Sales equal to 360 by 12%. 360 by 12%. 360 by 12% was the sales figure. 30 lakhs. Clear? Then you will say asset turnover is equal to sales by asset. Get the asset figure. Sales by asset. How much? 12 lakh. Now equity multiplier is 12 lakh by 4 lakh. 12 lakh by 4 lakh. I could have directly got 90% itself. But okay, the approach says that you will have to multiply the 3 and then give. 12 lakh by 4 lakh. You will get 90%. Same answer. Answer is not going to change. Just that it has to be broken down into 3 subparts. Clear? Okay. Now we get into something called as balance sheet preparation. With the ratios, we'll have to finally prepare a balance sheet. Sometimes we will prepare only P&L, sorry, only balance sheet, sometimes income statement as well as balance sheet. Go through 8 and write this format in your notebook. Write the balance sheet format in your notebook. Some figures given, some figures will calculate. Go through the question and write the format. Go through the question first and then write the format. write the format of balance sheet. Okay, I'll quickly discuss now. We have the format of balance sheet here. When the format of balance sheet given, it makes it little easier for us to solve the question because we know what items to calculate here. I need long-term debt, fixed asset, inventory, debtors and cash 360 days a year. All sales are on credit basis. Tell me what is the first thing we can calculate here? Long-term debt. Note 1. Please number your notes always. Note 1. Computation of long-term debt. Computation of long-term debt. Long-term debt divided by shareholder fund is equal to 0.6 by 1. Long-term debt by shareholder fund is 0.6 by 1. What is the shareholder fund figure? Sorry? 9 lakhs including reserves. Long-term debt is, this was an exam question, a fairly simple one, 5 lakh 40. So I write this 5 lakh 40 here. In bracket, write note 1. Please number your notes. It is very difficult else to follow the answer. Note 1, 5 lakh 40. What is the next thing we can do? How will you calculate? Using total asset turnover ratio, put a total now. Put a total of the liability side. Put a total of the liability side. How much? Which is the total of the asset side also. 1740 is the total of the asset side. Note to computation of sales. Always number your notes. Note to computation of sales. Total asset turnover ratio is equal to sales by total asset. 2.5 is equal to by 1740 sales figure. 40, 43 lakh 50,000. Next, what we can do is debtors is equal to note 3. Debtors equal to sales into how many days they mentioned? 30 by 360. All sales is credit sales and 360 days. 4350 into 30 by 360. 3 lakh 62. In bracket note 3. Number your notes. I can calculate inventory also and then I can calculate. Anything is fine, but number your notes. Note 3, 362, 500. Debtors figure. Clear? What's the next thing we can use? Inventory turnover ratio. Next, computation of inventory. Note 4. Inventory turnover ratio is equal to COGS by stock. We'll take this as closing stock itself. No opening, closing, breakup. COGS by stock. Inventory turnover ratio is 7.5. COGS is sales into 75%. Sales into 75%. Sales into 75%. GP margin 25%. What's the number you get? 4 lakh. Stock note 4, 4 lakh 35,000. Clear? Which is the next ratio we can use? Current ratio will give me current asset. Cash will become balancing figure. Cash will become balancing figure. So next, note 5, computation of cash. Current assets is equal to 2.9 into 2.9 into 3 lakh, and cash equal to 870 minus 435 minus 362 500. What's the number you get? 72. Fixed assets is balancing figure. This is note 5. 72 500. Fixed assets balancing figure. 8 lakh. Clear? Any doubts on this? Okay. Okay, we'll take a break now. I'll resume at 10:15. Okay, let's proceed now. So we are done with some part of ratio analysis. It's a chapter which is driven by practice. So we'll keep doing some more question. Let's come to 9. Go through the question. Go through question 9. Okay. Again, a question where the format is given. So because of that, it will become a little simpler for us to do. Open the balance sheet format which is given as it is. Open the format of balance sheet. Liabilities amount, assets amount. Open the format. Let's go item by item. First, they have given the balance sheet. The heading is wrong. The this in the top, I think this there's an error here. That's okay. 31st March 22 and 23 is given. We are preparing 31st March 23 balance sheet. Copy the number. Share capital 50 lakh. Reserves and surplus 25 lakh. Long term loan 30 lakh. Three items are given in the question. Copy paste them 50, 25, and 30. Share capital, reserves and surplus, and long term loan. Now tell me what's the first thing we can calculate. Sales. The increase in reserves and surplus is the profit for the year. Increase in reserves and surplus, the profit for the year. Note 1, computation of sales. Computation of sales. Increase in reserves is equal to 5 lakh. Increase in reserves is 5 lakh. Net profit ratio is 8%. So 8% of sales equal to 5 lakh. Sales equal to 5 lakh divided by 8%. 62 lakh 50,000. That's the sales figure. 5 lakh divided by 8%. Clear? What's the next thing we can calculate? Debtors. Okay. Note 2, computation of debtors. Computation of debtors. Question has said debtors represent 90 days of sales. Debtors equal to sales into 90 by 360. Sales into 90 by 360. How much you get? 1562, 500. Go to the main working note. Sundry debtor, note 2. Always number the notes 1562, 500. 1562, 500. What's the next item we can calculate? Stock. Okay. Note 3, computation of stock. GP is given. With that, we'll get COGS. GP margin is 20%. COGS is equal to 80% of sales. 80% of sales. 50 lakh is the COGS number. Stock turnover ratio with COGS is 4 times. So stock turnover ratio is equal to COGS by stock. Stock is 12 lakh 50. Breaking this into opening closing is not possible. I directly take this number. Stock is 1250. Any doubts on this? Stock figure in bracket note 3, 12 lakh 50. What's the next thing we can calculate? Right? Long term loan is already there. Okay, cash or fixed asset, both of them can be done. Let's do first cash, computation of cash. Cash equal to COGS into 1.5 by 12. How much? 6,25,000. This is note 4. Then it says long-term loan has been used to finance 40% of fixed asset. What this means is, right, long-term loan equal to 40% of fixed assets. Long-term loan equal to 40% of fixed assets. Divided by 40% is fixed asset figure. How much the fixed asset? 75 lakh. Put a total of the asset side, sundry creditor, balancing figure. Total of the asset side, one crore. Okay, 9,37,500. Same total this side, 1 crore 9,37,500. Balancing figure. 437 500. Clear? Any doubts on this? Go through 10. Go through 10 and open the format. Here some assumption based answer will be there. I'll explain them. Open the balance sheet format. Open the format. Share capital 20 lakh, total 50 lakh. Can we start? Other side total also write 50 lakh. Asset side total is also 50 lakh. Liabilities total they have given. Which is the first ratio I can use? Okay, debt to total asset ratio. Listen, they have taken this to be total outside liability. The term debt has three meaning as per ICI material itself. One is called short term debt, sorry, one is called long term debt, second is called total debt, third is called total outside liability. What is total outside liabilities? Long term debt and accounts payable put together. Long term debt and accounts payable put together. Without that assumption, the balance sheet total will not match. You will get some negative numbers. So here they have taken it as long term debt plus accounts payable for the ratio of debt to total asset ratio. Otherwise, balance sheet will not tally here. You will get negative numbers. So working note 1, computation of note 1, computation of total outside liabilities. Total outside liabilities and reserves and surplus. In fact, the entire liability side will get over here. Total outside liability and reserves and surplus. Debt by total assets. Debt by total assets is equal to zero point 0.4. Debt meaning is total outside liability. What is outside liabilities? Long term loan and accounts payable by 50 lakh. By 50 lakh is equal to zero point 0.4. This will give you total outside liability 20 lakh, which means reserves and surplus is equal to reserves and surplus is equal to 50 lakh minus outside 20 lakh minus share capital 20 lakh. Share capital 20 lakh. Reserves and surplus. If I take it as long term loan only, balance sheet tallying will become difficult. Some negative numbers you will get. Reserves and surplus is 10 lakh. For calculating long term loan, they have given one more ratio in the question. What is the ratio they have given? Long term debt to equity ratio. Now I'll use that and get long term debt. Note to computation of long term debt. Computation of long term debt. Long term debt by equity is equal to 0.3. Long term debt by equity is equal to 0.3. Equity is 30 lakh. Long term debt is equal to 9 lakh. With this, liability side is over. Long term loan 9 lakh. Note 2. Accounts payable balancing figure 11 lakh. Accounts payable balancing figure 11 lakh. Clear? This is as far as the liability side is concerned. Tell me which ratio will help in asset side. Inventory holding period and COGS is given. With this, I'll be able to get the inventory 360 days a year. Question has said 360 days a year. Let's do note 3, computation of inventory. Computation of inventory. Inventory is equal to COGS into 60 by 360. 60, yeah, 60 by 360. 60 by 360. 10 lakh. 10 lakh 66 667. Inventory note 3. 10 lakh 66,667. Clear? Next item is which one? Receivable period is there. Next, note for computation of receivables. Computation of receivables. What is the GP margin given in the question? 20%. COGS is equal to 80% of sales. COGS is equal to 80% of sales. Sales is equal to 80 lakh. Debtors is equal to 80 lakh into 36 by 360. 8 lakh. Debtors is 8 lakh. 36 by 360. So accounts receivable note 4. 8 lakh. What's the next ratio we can use? Only one ratio we are not used to. Quick ratio will give me quick asset. What is quick asset is including cash, these inventory, sorry, receivable, cash and receivable put together. Next, computation of cash. Quick assets is equal to 0.9 into current liability. 0.9 into 11 lakh. From this 990, remove the debtor figure. Remove the debtor figure, you will get the cash. Quick asset is receivable plus cash. 0.9, sorry. No, quick asset as it is. Stock is already removed. No, quick asset doesn't have stock. No. Quick asset is total of receivable and cash. If it has current asset, from there you remove stock, you get quick asset. Quick asset is 9 lakh 90, which is total of accounts receivable and cash. 9 lakh 90 is the total of accounts receivable and cash. Cash is balance. Cash is how much? 1 lakh 90,000. Note 5. Fixed asset balancing figure. Fixed asset balancing figure. How much? 2943, 333. Clear? Go through 11. Again, a good question. Go through this. Okay, a balance sheet is given. Lot of extra information is there. Question requirement is trading P&L and a balance sheet. Format is not given. So we'll first open a trading account, 4 5 lines, trading P&L together and balance sheet. Open and keep it ready. We'll fill it as we get data. So first is open trading and profit and loss account of Ganesha Limited for the year ended 31st March 2014. Particulars amount. This could be some 10 lines type. As we get information, we'll fill it. Some 12 lines you can leave. Then balance sheet. Again, just open and then leave it. Balance sheet of Ganesha Limited as on 31st March 2014. Liabilities amount, assets amount. Liabilities amount and assets amount. Okay, we'll now look at the data and then try to fill whatever is possible. First line, the company went in for reorganization of capital structure with share capital remaining the same. So 1 lakh remains same. 1 lakh is equal to 50%. Other items will automatically come. So let's close the liability side. Share capital in the liability side. Share capital in bracket 50%. 1 lakh. Share capital 50% is 1 lakh. Other shareholder fund, technically reserves and surplus. Other shareholder funds in bracket 15%. If 50 is equal to 1 lakh, 15 is equal to how much? 50 equal to 1 lakh, 15 equal to 30,000. Other shareholder funds 30,000. 5% debentures 10%. 50 equal to 1 lakh, 10 equal to 20,000. Trade creditors 50,000. Trade creditors 50,000. So this part is over. We have kind of closed the liability side. Debenture were issued on 1st April. Interest being paid annually on 31st March. Go to the P&L. Leave some 5-6 lines for trading account. To interest. Interest 20,000 into 5%. To interest 20,000 into 5%. 1,000 rupees. Land and building remain unchanged. So right in the other side, land and building remain unchanged. Land and building remain unchanged. What's the value of land and building? 80,000. Additional plant and machinery has been bought and a further 5,000 depreciation written off. Total fixed asset constituted 60% of total fixed and current asset. First write plant and machinery less depreciation. We'll write an amount in the outer column. Plant and machinery less depreciation. Earlier 15,000 was the accumulated depreciation. Now another 5,000 is charged. Another 5,000 is charged. So 20,000. Outer column figure we'll see in some time. 20,000. This will go at one more place. Where is it? In the P&L to depreciation. To depreciation 5,000. Now liability side total. Liability side total is how much? 2 lakh. Asset side total is also 2 lakh. This means my fixed assets is 60% of total assets. It says 60% of total fixed and current asset. Fixed asset figure is what? 60% of the assets. So come down, note 1. Computation of plant and machinery. Plant and machinery. Fixed assets is equal to 60% of 2 lakh. Plant and machinery is 40,000. 120 minus 80. 120 minus 80. And this side plant and machinery 60,000 minus 20,000. 60,000 minus 20,000. Clear? We'll go ratio by ratio. So we have used this ratio. Kind of asset side is also somewhat over. Working capital ratio, no use. What is working capital ratio? Current ratio. Current asset figure I already know. Current asset is 80,000. Fixed asset is 1,20,000. Overall is 2 lakh. I will use the quick ratio. With the current ratio and quick ratio, we will be able to get the stock figure. We'll be able to get the stock figure. Note 2. Computation of stock. Computation of stock. Quick ratio is equal to quick assets by current liability. Quick assets by current liability. Quick assets by current liability. What is the quick ratio given? 1 equal to quick asset and liability we have in the balance sheet 50,000. Quick asset is equal to 50,000. Current asset is 80,000. Current asset is 80,000. Stock balancing figure. 80 minus 50, 30,000. 80 minus 50, 30,000. Clear? Stock is 30,000. I think balance sheet is almost over now. Any doubts on this? In the asset side, current assets, right? Right, current assets, underline that. First item is stock, note to 30,000. Stock is 30,000. Debtor, they have mentioned in the question. Debtor is what? 4 by 5 of the quick asset. Debtor is 4 by 5 of the quick asset. We have already calculated the quick asset figure. Quick asset is 50,000. Debtors 50,000 into 4 by 5. Balance, I take it as cash and close it. That's all. Cash is the balance quick asset. Clear? Any doubts on this? With this, we are done with balance sheet. Now I have to complete the P and L also. For P and L, what is the starting I can do? Sales. How can I get the sales figure? How can we get the sales figure? Sorry? How will you get the sales figure? No, no reserves. Because reserves NP margin has to be given. It's not given. Very simple. No, debtors is there. No, debtors is 2 months. It says debtors is revealed a credit period of 2 months. Now, right, debtors is equal to sales into 2 by 12. Sales into 2 by 12. 40,000 is equal to, technically it's the credit sale. No cash sales is there in the question. Clear? Sales is 2,40,000. Now, they have also given stock turnover ratio. Stock turnover ratio will give me average stock. The quick ratio was giving me closing stock. Stock turnover ratio will give me the average stock, which I'll break it as opening and closing. Opening and closing. Next, stock turnover ratio is equal to COGS by average stock. Stock turnover ratio is equal to COGS by average stock. COGS by average stock. 8 equal to 2,40,000 into 85%. Into 85% by average stock. By average stock. By average stock. Was the average stock? Split this into two. Opening, closing. Closing is 30,000. Closing is 30,000. Closing is 30,000. A good problem. Good number of adjustments are there. Closing is 30,000. Opening how much? That's all. I think we'll be almost done with P and L now. 21,000. Opening stock 21,000. Clear? Can you proceed? To opening stock 21,000. By sales, you will have to number your working notes or reference you have to give. I have not numbered it. In exam, please take care of that. By sales 240. By closing stock 30,000. to purchases balancing figure, to gross profit, 2 lakh 40 into 15%. Balancing figure is the purchases. Purchases is the balancing figure. How much? Sorry, 2 lakh 13,000. By GP, this side to net profit, and expenses is balancing figure. How will net profit come? I'll explain. By GP 36,000. Net profit is 10% of net worth. Return on net worth is nothing but return on equity. Return on net worth was 10% is nothing but return on equity. So return on equity is profit after tax divided by net worth. Divided by net worth. So net profit is equal to 10% into 1,30,000. Net worth is 1,30,000. Share capital plus other reserves and surplus. 10% into 1,30,000. Return on net worth is return on equity. Return on equity. Expenses balancing figure. Return on equity. 10% into 1,30,000. Clear? Any doubts on this? Lot of good ratios have been used in the question. Any doubts on this? Can we proceed? Go through 12. Okay. Lot of items have been given. No major linkages are there. As we do only, we'll understand. One, they have asked for a balance sheet. Income statement. Statement means we'll do a particular amount in a vertical form rather than doing it as a particular amount, rather than not as an account form. Let's open income statement. Income statement. Particulars and amount. Maybe some 10 lines, and then balance sheet. Liabilities amount, assets amount. Okay, we'll go item by item. Every item, suddenly some useful information will be there, and accordingly we'll do the calculation. First is GP, gross profit has been given. So this will somewhere help us. What you can do is right here, sales less COGS. Statement is mostly like this, gross profit. Sales less COGS gross profit, then we deduct all other item and then get net profit. Sales less COGS gross profit. How much is the gross profit? 1 lakh 20. 1 lakh 20. Shareholders funds 5 lakh. What is shareholders funds? Share capital reserves all put together. In case breaking it further is possible, we'll try to break it, but looking at the data, I don't see that possibility. So write shareholder funds in the liability side. Shareholder funds in the liability side 5 lakh. Item by item you analyze, it will automatically get over. Next item is what? GP margin 40%. Let's go back to the income statement. Sales is what now? GP margin 40%. 120 by 40%. 3 lakh. COGS balancing figure 180. 3 lakh and 180. Next item, NP margin 10%. NP margin 10%. One good thing is tax is nil in the question. Tax is nil in the question. If tax is nil, what happens is I need not worry about whether this is net profit before tax or after tax. So from COGS, right, less, from GP, right, less operating expenses or less expenses, EBIT, less interest, EBT slash EAT, both are same here, that's all. EBT slash EAT, 3 lakh into 10%. EBT slash EAT is 3 lakh into 10%. Net profit margin. Net profit margin 10%. Please use this PBIT to PBT ratio and tell me the PBIT figure. PBT is 30,000. Use PBIT to PBT ratio. PBIT to PBT ratio. PBIT by PBT is equal to 2. 2 into 30,000. 60,000. Income statement is over. Expenses balancing figure 60. Interest balancing figure 30. Expenses balancing figure 60,000 and interest balancing figure 30,000. As you keep doing, things will happen. That is what you'll have to keep solving, keep using every ratio. Okay, this question we have credit sales and total sales information. So there is going to be a difference between when I do debtors, I'll have to do it on credit sales. So total sales, let's do the debtors calculation, whatever number of working note 1, I think mostly, note 1, computation of debtors, credit sales is equal to 3 lakh into 80%, 2 lakh 40, 3 lakh into 80%, 2 lakh 40. Debtors, what they mentioned in the question. Average collection period 30 days. Debtors equal to 2 lakh 40 into 30 by 360. 30 by 360. How much? In the asset side, leave some 2-3 lines gap. Current assets. In that first item is debtor note 1, 20,000 rupees. Debtors note 1, 20,000 rupees. Clear? Which next ratio? Total asset turnover will give me the total asset figure. Let's use the total asset turnover ratio. We'll get the total asset figure itself. Note 2, computation of total assets. Computation of total assets. Total asset turnover ratio is equal to sales by total assets. Sales by total asset. Total asset turnover ratio is how much? 0.4 is equal to 3 lakh by total asset. 3 lakh by total asset. What is the total asset figure? 7 lakh 50. Go to the balance sheet. Leave some 3-4 lines gap after current asset and both the side total write 7 lakh 50. Both the side total is 7 lakh 50. Liabilities and assets total. Was the next ratio to be used? Stock turnover, but very clear, use sales as turnover. For stock turnover, we normally use COGS, but question specifically says use sales. So stock turnover ratio, note 3 stock turnover ratio, computation of stock, specific requirement of the question, stock turnover ratio is equal to sales by stock. Normally COGS by stock, 3 lakh by stock. If nothing was given, we would have used COGS. Stock is 60,000. Clear? In the asset side, stock, note 3, 60,000. Next ratio given is current ratio. I'll use this in some time because as of now, I don't know. Operating expenses excluding interest is 60,000. Anyway, I don't know why they gave this because it's already done here. We have already returned 60,000. That is closed. Long-term debt to equity is 40%. This side, long-term debt. Long-term debt, 5 lakh into 40%. Long-term debt to equity, 5 lakh into 40%. Okay, balance sheet is over now. 2 lakh. Current liability balancing figure. Current liabilities is balancing figure. Current liabilities balancing figure. How much? 50,000. Current assets is double of 50,000. So cash is balancing figure. Current assets is double of 50,000. Some of this you will have to write as a note in exam. In class, some of it I'm directly writing it. Cash is total current asset is double of 50,000, 2 times current ratio. So cash is equal to 1 lakh minus 80,000. Fixed assets balancing figure. 6 lakh 50,000. Clear? Any doubts in this? The only thing is as you keep using multiple ratios, you'll automatically get to the answer. Any doubts in this? Okay. A very lengthy question. Oh, go through the question and write the formats. They have given the formats. Please write them. Write the formats in your notebook. Go through the question. Just give me a minute. I think net got disconnected. Note down the format. Profit and loss account. Balance sheet. Okay, this is the information given. Let's start using them and then keep getting the various number. Needed, we'll do a note. Otherwise, directly we'll keep writing it. Uh, the most important figure is this fixed asset given in the question 1 crore 30 lakh. With this, what we get is all this data is okay. Let's first use the fixed asset and get the fixed asset to current asset, fixed asset to sales is given. Fixed asset to current asset and fixed asset to sales is given. So by sales is 1 crore 30 lakh into 3 times 3 crore 90, 3 crore 90, 1 crore 30 into 3, 3 crore 90. Ideally, a separate working note is needed for this. I'm avoiding working notes to the extent possible. 3 crore 90. With this, I'll close the debit side part also. GP they have given 3 crore 90 into how much? What's the GP margin? 15%. 3 crore 90 into 15%. 50, 58 lakh 50,000. 3 crore 90 into 15%, 58 lakh 50. The gap is called COGS, and in that COGS 20% is raw material, 10% is wages, balancing figure is the balance item of the COGS figure, so right, COGS is equal to, somewhere write a note, COGS is equal to 3 crore 90 minus 5850, 3 crore 90 minus 5850, 3 crore, and now direct material consumed 3 crore 31 lakh 50,000 into some percentage they've given, 20% into 20%, 3 crore 3150 into 20%, how much? 66 lakh 30,000. Direct wages 3 crore 3150 into 10%, how much? This is balance 70%. 2010 balance 70 is this. GP part is over. Trading account is over. Trading account part is over. Lengthy question. 2 crore 32 lakh 5,000. Any doubts on this? With this, the GP part is over. We bring it down by gross profit 5850. NP is given in the question. Net profit is given in the question. 3 crore 90 into 8%. Selling and distribution expense balancing figure. 3 crore 90 into 8%. 31 lakh 20,000. This gets over now. Balancing figure, selling and distribution expense, how much? 27 lakh 30,000. With this, P&L part is over. Clear? Now coming to the balance sheet part, again we have some of the information readily available. It says debt collection period. Okay, we'll go item by item first. Stock of raw material is what? 3-month usage. Stock of raw material is on raw material consumed. Stock of raw material is on raw material consumed. So whatever note number, stock of raw material is equal to raw material consumed into 3 by 12. Raw material consumed into 3 by 12. Raw material consumed is 6630 into 3 by 12. Into 3 by 12. What's the number you get? 16 lakh. You'll have to number the working note. That part you take care. 1657 500. Then stock of FG 6% of COGS. 6% of COGS. 3 crore 31 lakh 50,000 into 6%. 6% of COGS. 19 lakh 89,000. 6% of COGS 1989. Clear? Then debtors is also mentioned 2 months. So debtors is equal to 3 crore 90 lakh into 2 by 12. 3 crore 90 lakh into 2 by 12. 3 crore 90 lakh into 2 by 12. How much? 65 lakh. Clear? Any doubts on this? Let us use this ratio, fixed assets to current assets ratio. This will give me the total current asset. Fixed assets to current asset and cash is balancing figure there. Fixed assets to current asset, cash will become balancing figure. Next, right? Fixed assets by current asset is equal to fixed asset by current asset is equal to 13 by 11 1 crore 30 lakh is equal to, or 1 crore 30 lakh by current asset is equal to 13 by 11. Current asset figure is how much? In that all current asset you remove, you'll get cash balancing figure. Tell me the balancing figure for cash. 1 crore 10 lakh minus everything else. 8 lakh 53 500. This side total is over 2 crore 40 lakh. Now use the current ratio formula and tell me the current liability figure. Or directly current, no ratio. 1 crore 10 lakh divided by 2. 1 crore 10 lakh divided by 2. 1 crore 10 lakh divided by 2. 55 lakh. I'm not using the separate note. In exam, obviously, you'll have to do a separate note. Some things you can write directly also. That's your wish. 55 lakh was the next ratio we can use. Long term loan to current liability. Long term loan is double. So 55 lakh into 2 times. Long term loan to current liability double. 55 into 2. 55 into 2. 1 crore 10 lakhs. Now the leftover amount is capital and reserves and surplus put together. Tell me first, what is the balancing figure here? What is the balancing figure in the asset side? 75 lakh, that is share capital and reserves put together. 75 lakh is the balancing figure, which we will break it as capital and reserves and surplus. So, right, net worth equal to 2 crore 40 lakh minus 1 crore 65 lakh. 75 broken as capital and reserves and surplus. Broken as capital and reserves and surplus. What is the ratio of capital and reserves and surplus? 1 is to 4. 1 is to 4. 15 lakh and 60 lakh. Clear? Any doubts on this? Done. 15 lakh and 60 lakh. Any doubts on this? Go through this. It's an excellent question with good amount of adjustments. May 25 RTP question. Go through this and open that format, whatever they have given. Open the format after going through it. It's a very good question with good adjustments being there. Okay, open the format. They have given it in vertical format, whatever way they have given, plus 2. Just open it that way itself. Balance sheet, particulars, amount. Share capital 36 lakh. Reserves and surplus 14% bonds current liabilities, trade payables, outstanding expenses, net of prepaid expenses. Opening WDV, okay, let's start discussing it. Quickly open the format. Let's start discussing now. Now, the two, three issues. One is this net of prepaid expense. Ideally, prepaid expense should go to the asset side. They've netted off and wrote it in the liability side. For all ratios, you have to adjust this item. That is one tricky adjustment. Apart from that, one more adjustment is there. Similar question, we have done it in our regular class, but this net of prepaid expenses an extra add-on they have done in this question. Now, let's look at what information is available and then try to calculate. First is stock turnover ratio. I cannot use it as of now. I'll see it later. Cash and bank balance is 10% of current asset net of prepaid. So there will be two current asset. One is current asset including prepaid expense. Second is current asset excluding prepaid expense. So of the excluding portion, it is 10%. First ratio, let's use this current ratio, which is 1.6 is to 1, and current liability is not 45 lakh. Current liability is 52 lakh 50,000. Current liability is 52 lakh 50,000 net of prepaid expense. I don't know why they wanted to do this. Ideally I could have just moved it to the asset side. So current liability figure is 52 lakh 50,000. Note 1, computation of current asset and current liability. Computation of current asset, in fact not current liability, current assets. Computation of current assets. Current asset by current liability equal to 1.6. 1.6 into 45 lakh plus 7 lakh 50. 45 lakh plus 7 lakh 50. How much? 84 lakh. Now listen, what will we go to the balance sheet here is 84 lakh minus 7 lakh 50, because 7 lakh 50 you have knocked off the other side. So from 84 deduct 7 lakh 50 and tell me the figure. 76 lakh 50,000. Ideally this should be 84, that should be 5250. Our issue will get sorted out. But they did this adjustment. In that, cash is how much they mentioned. 10% of net amount. 10% of net amount 7 lakh 65. 10% of net amount 7 lakh 65. Clear? Tell me what's the next ratio we can use. Which ratio we can use? It was a very good question. Lot of interlinkages need to be known. Which ratio can help us now? Sorry, capital gearing I cannot use. Capital gearing ratio formula is bonds divided by capital plus reserves. I don't know the I don't know the reserves figure. I don't know the bonds figure. I'm going to use net fixed asset. Fixed asset is 25% of total assets, not total life. Both are same. Total liability, total asset is same. Which means current asset is 75% of total asset. Current asset is 75% of total asset. Fixed asset is what? 25% of total liability. What is total liability? Total asset. So right, fixed asset is equal to 25% of total assets. Current asset is equal to 75% of total assets. 84 lakh is equal to 75% of total assets. 84 lakh divided by 75%. This is not the total which you can write in balance sheet, because from this that knocking off has to be done. 1 crore 12 lakh, but I cannot write this in the balance sheet. In the balance sheet I have to knock off 7 lakh 50,000. From 1 crore 12 lakh we have to knock off 7 lakh 50,000. That is what I can write in the balance sheet. 1 crore 12 lakh, knock off 7 lakh 50 and tell me the figure. Right, 1 crore 4 lakh 50,000. 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 Outer column balancing figure fixed asset is how much? 20, 28 lakh. 28 lakh. Outer column is 28 lakh. Any doubts on this? A very good question. The add-on adjustment, if it was not there, it would have become more simpler. But okay, 28 lakh. Then the question has said rate of depreciation would have been given in the question, 15%. So 100, 15, 85 is 28 lakh. Tell me the 115 figure. 85 is 28 lakh. 85 is 28 lakh. 32, 94, 118. And this is 15% of that, which will be 494,118. 494,118. Clear? Almost getting closer to the end. Tell me this figure, outer column total. Outer column total here. This outer column total. 1 crore 4 lakh 50,000 minus 45 lakh. 1 crore 4 lakh 50,000 minus 45 lakh. This we will split into share capital, reserves and bonds now. 5950. This 5950 is called capital employed. Capital employed is 5950. Now write capital employed, break it into two: equity and debt. Equity and debt. Equity and debt. Equity and debt. And capital gearing ratio is equal to debt by equity. It's basically debt plus preference. Preference is not there. Divide by equity plus reserves. Debt by equity. What is the capital gearing ratio given? 0.6 equity is equal to debt. 0.6 equity is equal to debt. Whatever is the equity value, debt is 0.6 of that. And I can say debt plus equity is 59 lakh 50. Substitute and get the figures now. Debt plus equity is 5950. 0.6 equity plus equity is 5950. 0.6 equity plus equity is 5950. How much is the equity figure? Whatever, debt equity, whatever you get. Okay, this is 5950 divided by 1.6. 37, 18, 750. Debt is 22, 250. Any doubts on this? 22, 31, 250, 37, 18, 750. Can you proceed? I go here. Debt figure is 22, 31, 250. Equity balancing figure 118750. 37 lakh, in that 36 lakh is share capital, balances reserves and surplus. Any doubts on this? Number your working notes. The most important adjustment will happen now. Any doubts on this? Clear? Can you proceed? Now, I don't know the inventory figure. I also don't know the receivables figure. And creditors is something which has to be separately computed. Inventory turnover ratio is given 15 times. And debtors turnover ratio is given 12 times. The problem for me is I don't know the sales information. I don't know the GP information. So here we are going to club these two items together and then calculate the number. How are we going to club it? Now write inventory plus debtor is equal to 7650 minus 7 lakh 65. 7650 minus 7 lakh 65. Inventory plus debtor is equal to 7650 minus 7 lakh 65. And what is inventory? Listen, inventory turnover ratio is 15 times. Inventory turnover ratio is on COGS. Debtors turnover ratio is on sales. Listen, sales is or debtor is X by 12. X by 12 and inventory is 0.8x by 15. What is 0.8x is GP margin 20%. GP margin 20%. I'll repeat again. I don't know the sales figure. I don't know the GP figure. I don't know the COGS figure. Sales is X. GP is 20%. COGS is 0.8x. 0.8x by 15 is the stock. And X by 12 is the debtor. X by 12 is the debtor. Write this. Solve it. You will get the answer to X, which is the sales figure. X is the sales figure. 0.8x by 15 plus X by 12 is equal to 6885. The slightly lengthier calculation. Sorry, 5 crore 3 lakh With this, I'm ending the solution. Balance, you can write it later if you want. Any doubts in this? Zero? ठीक है, 049. Once you get the sales figure, sales the sales was the trickiest calculation. Sales figure turns out to be 5 crore 0378050. From there, you get debtors divide by 12. You will get inventory divided by 15 and creditors is divided by 10. Balance is more of a formality. With that, you'll be able to complete the balance sheet. Any doubts on this? Here I had to link both of them together. Debtor turnover ratio and inventory turnover ratio together we had to link and then do the calculation. Any doubts on this? Clear? 15 is something you can do later. It will not take much time. Go through 16. Okay, let's start doing it. They've asked for a trading account, P&L account, and a balance sheet. Certain ratios have been given. One assumption area I've taken for quick ratio, do not consider bank OD to be part of current liability, which is not logical. Okay, this ICA has done, I've written it there so that our answer matches. If it comes in exam, I'll consider bank OD to be part of only current liability, which is what is logical. Our other logic can be if bank OD is long term in nature. That's a different story. But otherwise, for quick ratio alone, they have not considered bank OD to be part of current liability. You keep doing in your notebook. I'm doing it in the screen. You refer in case you want. Else keep trying it. You'll be able to do it. If you get stuck, then refer the screen. Trading account format, P&L account format, and the balance sheet format. I'll discuss it in 2 minutes. Kind of not a very tricky one, manageable question. Only thing is that bank overdraft, what they have done, you will have to follow that adjustment. Otherwise, tallying will be difficult. In the quick ratio, in the current liability, we'll have to remove the bank OD. Not mandatory, but question has done. Okay, I start discussing the solution now. Whatever you have done is fine. Others you will complete later. Let's start discussing now, guys. First is current ratio and working capital combination. That will give you current asset and current liability. Working capital is given as 120, current ratio 2.5. Current asset, you end up getting it as 80,000 current liability and current asset is 2 lakh. Ideally, for quick ratio, I'll use current liability. I don't know why ICI did it, but they have done this. In the current liability, I have to remove bank OD. My quick asset figure is 84,500. Quick asset figure is 84,500. Removing the bank OD from the current liability. Removing the bank OD from the current liability. Balancing figure stock is 115,500. So I'll take the stock to the main working note and write stock as 1,15,500. Sales is given 7 lakh 30, write it in the P and L credit side. Debtors is equal to 7 lakh 30 into 40 by 365. That will give you debtors figure. Cash is balancing figure. Asset side, current asset part is over. In the current liability, 80,000 is there. Bank OD 15,000, others 65,000. Others is 65,000. So with this, the current liability part and current asset part gets over. Now for fixed assets, we have to use this ratio, which we have done in one of the earlier question also. Fixed asset by proprietor fund 0.6. So fixed asset is equal to 0.6 proprietor fund. Assuming no debt and all is there in the question. Proprietor fund is equal to fixed assets plus current asset minus current liability. When you use that, you will get proprietor funds as அவங்களுக்கு கால் பண்ணி கேட்டுக்கோங்க. 99405 99405 50,999. Okay, so the proprietor funds part is 3 lakh we have got. From this 3 lakh, fixed asset figure is 1 lakh 80,000. Fixed asset figure is 1 lakh 80,000. Balance sheet is over. In the P and L part, closing stock is there. Opening stock is, they have said, closing stock is 10% more than opening stock. Closing stock is 110% of opening stock. Opening stock is closing divided by 110%. Divided by 110, you get this figure. Purchase balancing figure. Net profit is 10 percentage of proprietor funds. Proprietor funds is owner's funds, which is 3 lakh rupees. Any doubts in this? With this, this part gets over. Any doubts in this question? One more question we have. It's a slightly lengthier question. Go through this. I'll do this. We'll do it together. Go through this first. Go through 17. go through the question, a slightly lengthier one. Okay. The financial statement and operating results revealed the following information as on 31st March 2023. Equity capital, working capital, bank OD, current ratio, liquidity ratio, proprietary ratio, cost of sales, debtor velocity, stock turnover, GP and NP is given. Closing stock is 25% higher than the opening stock. There were also free reserves brought forward from earlier years. Current assets include stock, debtors, and cash only. Current liability except bank OD is treated as creditor. Expenses include depreciation. For the year ended 31st March, this earlier is for 31st March 23. Then for 31st March 24, total sales 20% higher as compared to previous. Balance stock, creditors, debtors, cash. GP has gone up from 20 to 25. NP to sales is 15 to 16. Fixed assets was old, sold long-term investments, bank OD, percentage of depreciation to fixed assets to be provided at the same rate. They have asked us two balance sheet, one 31st March 23 and 31st March 24. So let's do it in the same working note itself. Balance sheet, particulars, two amount columns, liabilities, amount, assets, amount. Liabilities, 31st March 2023 and 31st March 2024. Liabilities and 2 years, assets and 2 years. We'll go item by item. Lot of information is there. First, let's close 23 and then we come to 24. For 23, first let's write the equity capital. Equity capital. How much is the equity capital? 20 lakh. I have working capital current ratio. Use the combination. Working capital current ratio. Quickly use the combination. Tell me current asset and current liability figure. Current asset and current liability figure. Current liabilities 4 lakh. Current asset. Clear? Any doubts on these two numbers? Leave some 3-4 lines gap. I don't know what will come in between. Current liabilities. Current liability. In the current liability, I have bank overdraft, which is given in the question. How much the bank overdraft? 1 lakh. Creditors balancing figure. 4 lakh minus 1 lakh. 3 lakh. 4 lakh minus 1 lakh. 3 lakh. Some items will come in between. We'll see as we proceed. They're given liquidity ratio. Liquidity ratios, quick assets by current liability. No need to remove bank OD and all. That question we did because they had done it. Otherwise, I don't think so that adjustment is needed. Just to solve the question, I've done it. Okay. I didn't want to, then we'll get stuck in the solution. Do liquidity ratio, quick asset by current liability. Current liability should be 4 lakh. That's what ideally they would have done. That question alone is an exception. What's the inventory figure you get? Okay. Okay, I'm not going to use that figure. Let it be whatever you have calculated, because there's another way of calculating inventory. Both may match, may not match. We don't know. There's another way. Stock turnover based on cost of sales. Stock turnover based on cost of sales may match, may not match. I'm not very sure about it. I'll do it. Whatever it is the number. What is the quick asset figure you got? Quick asset is how much? Quick asset is 6 lakh. Ideally, the stock figure should be 4 lakh, but there's another ratio. I don't know why they gave another ratio. There's another ratio given in the question. Let's do that. Stock turnover based on cost of sales 4 times. Stock turnover based on cost of sales. Now write stock turnover ratio is equal to cost of sales by average stock. Cost of sales by average stock based on cost of sales, whatever wording the question has said, based on cost of sales by average stock. 14 lakh, sorry, 4 times is equal to 14 lakh 40 by average stock is how much? Break it as opening, closing. Average is 360. The question has said closing stock is 25% higher than the opening stock. So this is A, this is 1.25A. Closing is 25% higher than the opening stock. Please calculate the closing stock and opening stock figure now. I think we will get that 4 lakh figure which they're talking about. You will get 4 lakh. Check, do the calculation. You will get the 4 lakh figure. Okay, both the ratios are tallying, that is good. Closing stock, your opening stock will be 2.25A divided by 2 is equal to 3 lakh 60. A is equal to 7 lakh 20 divided by 2.25. How much is the opening stock figure? 3 lakh 20. Closing is 1.25 times of this, 4 lakh. Ideally, I need not have done this, but anyway, it matches, that is okay. 4 lakh rupees. Otherwise, I was thinking if at all they did anything with the bank OD. Any doubts on this? In the balance sheet, stock, whatever note number, you note it, 4 lakh. 24 we'll see it later. This is 4 lakh rupees. Clear? What's the next item we can calculate? Which ratio you want to use next? Use the proprietary ratio or normal adjustment. Proprietary ratio is equal to, they have given fixed assets by proprietor fund is equal to 0.75. Fixed asset equal to 0.75 proprietor funds. 0.75 proprietor funds. Fixed asset equal to 0.75 proprietor funds. Proprietor funds is equal to fixed assets plus current asset minus current liability. Get the proprietor fund figure. Fixed assets figure will be 18 lakh. I think balance sheet is going to be almost over now. Fixed asset is 18 lakh. Proprietor fund 24 lakh. Fixed asset 18 lakh. Any doubts on this? This is a usual adjustment. I think we have done now fourth, fifth time. Any doubts on this? Now right here, fixed asset 18 lakh. Fixed asset 18 lakh. And then the question has said the proprietor funds. Right here, I'll explain what they're saying. Free reserves or opening reserves, current year profit. Opening reserves and current year profit are called as free reserves, something they've mentioned in the question. I'll explain. Free reserves, current year profit, all put together is 24 lakh rupees. In that, they said there were also free reserves brought forward from earlier years. So ICI separately written that figure, and the current year profit they've written it separately. Even if I write it together, also doesn't make any big difference. But they've written it separately. We are almost done. Just get me this figure, debtor figure. Debtor cash. Total this side 28 lakh and this side also 28 lakh. How 28 lakh is 18 plus 10 and this side 24 plus 4. 24 plus 4. Get me debtors figure. How will you get debtors here? From cost of sales, we will get the sales figure. After we get the sales figure, sales into 2 by 12. Sales into 2 by 12. Sales into 2 by 12. Now write cost of sales equal to 14 lakh. Technically, there is an error. I feel this should be cost of goods sold. It is not cost of sales. It should be cost of goods sold, because COGS and GP can be linked with together. COS and NP will be linked with together, but ICI has not done NP linking. I think they have done only GP linking. So it should be COGS. The word should be COGS. That's what I feel. I'll just confirm to you. Yeah, they have taken this as COGS, not a COS. This is taken as COGS, not a COS. Maybe there is a drafting error there. So right, COGS, call it a COGS itself. COGS GP equal to 20% of sales. COGS equal to 80% of sales. Sales equal to how much? Debtors equal to sales into 2 by 12. 18 lakh into 2 by 12. How much you get? Asset side is over. Debtors is 3 lakh. Cash balancing figure is 3 lakh. This side current year profit is 18 lakh, 18 lakh, which is your sales, 18 lakh into 15%. 18 lakh into 15%. 2 lakh 70,000, and reserves they've written separately. I don't find any big difference. They've written it separately. 270. How much the balancing figure? So they've written separately, doesn't make any big difference. I could have clubbed them together also and done. Next year, I'm quickly discussing it. We are not writing it. Next year, almost available. The stock figure is given directly, creditor figure is given directly, debtor figure is given directly, cash figure is given directly, long term investments have been purchased, which is given directly, bank OD is fully discharged, so it will become 0, share capital will remain same, reserves and surplus will be balancing figure. Only point is portion of fixed asset was very old and was sold by the organization. Portion of fixed asset was very old. So today the fixed asset is 18 lakh. In this, book value worth 1 lakh 80 is sold. Book value worth 1 lakh 80 is sold. So 18 lakh minus 1 lakh 80 is 16 lakh 20,000. On this, they have said you have to charge depreciation, percentage of depreciation to be provided at the rate in the previous year. What is previous year rate? 90,000 on 18 lakh. 90,000 on 18 lakh rupees of fixed asset. The depreciation was 90,000. Proportionate depreciation they charged and got the fixed asset figure. Got the fixed asset figure. Others are very simple, straightforward given. So fixed asset figure alone will be little tricky. Given directly, given directly, given directly, given directly. This is given directly. This is given directly. So the balancing figure is reserves and surplus. Clear? Any doubts on this? With this, my discussion on ratio analysis get over. But this chapter, I will 100% tell you to do all the MCQ again. The MCQ part, I have not discussed the MCQ. There are good number of MCQs which are there in this material itself. And apart from this material, our concept book will have MCQ. First, complete this. You time is available, then try to complete the other one also. But these are very mandatory. Some of them are very, very tricky kind of adjustment also. With this ratio analysis get over, I am left with two main chapters. One is your working capital and investment decision. We'll take a break of some 15 minutes now, and then I start with working capital. We'll not be able to do fully the working capital part, but we'll see how much ever we can complete today. We'll take a break of 15 minutes and then do the balance part. Okay, now we move to the last two chapters which are pending. In that, I'll try to cover maximum of management of working capital. Investment decision is something you can manage on your own, and videos are available in my YouTube channel in case you want to revise the using earlier videos. That is possible. My plan was anyway to cover. I in fact wanted to cover all the three blocks, the first three blocks. In that, working capital is pending, and we'll try to cover as much as possible. We'll see how much can be done. The only thing is it is a slightly heavier area because there are a lot of areas which needs to be discussed in working capital. First, we will discuss something called as estimation of working capital. After we are done with estimation of working capital, there are three main forms of working capital, which is cash, debtor, inventory, which are three separate subsegments. So cash management will be there, debtor management will be there, inventory is not there, which is basically EOQ calculation, which you see in costing. We don't separately cover it here. And payables management will be there, which is part of the debtors management itself. And there's something called as maximum permissible bank finance calculation, or how much funding the bank is going to give. The objective of learning this chapter is to find out how much is the money needed for day-to-day operations of the company. And we have to, once we get to know the day-to-day requirements, we go to a bank and take a loan against it. In that, the first segment is how do I decide how much money is needed for day-to-day operations of the company, where we have something called as a simple method, operating cycle method, and then there is something called as a detailed method, which is called line by line estimation. So if you see the chapter, I have broken down into 7 subsegments. Liquidity versus profitability, I don't discuss any problem here. It's just a concept, theoretical kind of a concept. Very rarely a problem may come. Then we have operating cycle method, normal method, then cash balance, cash budget, and then two segments in receivables management. One is called factoring arrangement, and second is relaxing or tightening of the credit terms. Let's directly get into operating cycle method first. Question 1. Go through the problem. Following information is provided by MNP Limited for the year ended 31st March. Raw material storage period, WIP conversion, FG storage, debt collection, creditor collection. All this we will have to calculate. They have given directly. Later question we will calculate it using ratio analysis understanding. Annual operating cost 25 lakh including depreciation. First is operating cycle, number of operating cycle, working capital on cash cost basis. Then there is some, if it's a market leader and want to discontinue something, and in case purchases are made on cash basis, what will happen? Now, what is operating cycle is time taken to convert the cash back into cash. Cash becomes raw material become WIP, WIP become FG, FG become debtor, debtor again becomes cash. Now, right, operating cycle is equal to raw material days plus WIP days plus FG days plus debtor days minus creditor days. Time taken to convert the cash back into cash. Raw material plus WIP plus FG plus debtors minus creditor. All the five have to be computed by us using ratio analysis understanding. All of this is directly given here. What is the raw material days? 45 days, WIP 20 days, FG 25, debtors is 30, creditors is minus 60. Creditor will reduce my cash requirements. This is the operating cycle in days. What's the operating cycle period? So it takes 60 days for us to collect or convert the cash back into cash. Next is number of operating cycles in a year. Number of operating cycles is equal to T60. The question has said 360 by 60. One cycle is 60 days. 360 or 365. They have said 360. Which means 6 times we are able to convert the cash back into cash. 6 times we are able to convert the cash back into cash after doing the full cycle of operation. Amount, why are we doing this cycles calculation? To find out what is the working capital needed. They said amount of working capital on cash cost basis. Cash cost means depreciation will be removed from the requirement, and non-cash cost or total approach means depreciation will be considered. So in a year I need 25 lakh rupees. In a year I need 25 lakh rupees, but in that 25 lakh there is a depreciation component. So 22 lakh 50,000 is what I need for a year. If my cycle was for a year, 20 to 50 is the working capital requirement, but my cycle is lesser, only 60 days period. Next, working capital requirement. Cash annual cost cash basis 25 lakh minus 2 lakh 50. And working capital requirement is equal to 2250, 30 by 360, 60 by 360, 60 days. 2250 is the yearly requirement. 60 days, how much money do we need? 2250 into 60 by 360. 60 by 360. 3 lakh 75,000. 2250 into 60 by 360, 375. Clear? Now they are saying company is a market leader and it has no competitor in the market. Based on a market survey, it is planning to discontinue sales on credit, deliver product based on prepayment. You are required to compute the reduction in working capital requirement. Now we'll write the cycle again. Debtors is zero now. Cycle will go down, working capital will go down. Cycle will go down. Debtors is zero. Please calculate now. Debtors is zero. Debtors become zero. How much? 30 days. New working capital requirement. New working capital requirement 30 days. New working capital requirement. Earlier it was 60 days, now it is 30 days. How much? 187 500, and they want what is the reduction. So from 375 it goes down to 187. Reduction is also 187. From 375 it goes down to 187. Our working capital requirements are going down because we are able to now collect money faster, basically without any credit. Reduction in working capital requirement. 375 minus 187. 187 500. Clear? Then the last part says increase in working capital. If all purchases now, sales was becoming cash sales, our requirements go down. Now purchases are on cash basis. Repeat the same original thing. Creditor is 0 days now. Creditor is 0 days now. Creditor 0 days. Debtor will continue to be there. Any rework is on part of original situation. Debtor is 30. Creditor now 0. Creditor is 0. How many days now? 120 days. New working capital requirement. 120 days. It will become 7 lakh 50. And there will be increase in working capital now. Increase in working capital requirement. Three lakh 75,000. 750 minus 375. 375 is the increase in working capital requirement. Fairly simple, straightforward, because all of this was given directly. Next question, we will try to calculate all these days and then do the computation. Any doubts on this? Clear? Okay, go through the question. Okay, we are required to find out the working capital requirement by operating cycle method. For operating cycle, I'll need raw material days, WIP days, FG days, debtor days, creditor days. Raw material is based on raw material consumed. WIP is based on cost of production. How do you remember? In the cost sheet, after closing stock of raw material, you'll get raw material consumed. After closing WIP, you get net works cost or technically COP. After FG, we get COGS. So the basis is whatever comes after that line item in the cost sheet. We'll first prepare a cost sheet so that we get these items which we need, which is COP, COGS, raw material consumed, cost sheet. Cost sheet of Beta Limited, particulars amount. We will not calculate prime cost, all that we don't need. Whatever is needed only we'll calculate. I don't need prime cost figure and all. Direct material, underline that. Opening raw material, add purchases, less closing raw material. This is our usual cost sheet, very simple analysis. Opening raw material, add purchase, less closing raw material. What's the opening raw material? 1 lakh 80. Purchases 11 lakh. Closing raw material 2 lakh. 180 plus 11 minus 2, 10 lakh 80,000. Direct wages 3 lakh. Was the next item given there in the P&L? Production expenses, we don't know whether it is production overhead or direct expense, doesn't matter. Let us production expenses. How much? 2 lakh. Total is called gross works cost. Gross works cost. Gross works cost. How much is gross works cost? 15 lakh 80. Add opening WIP, less closing WIP. We get net works cost, other name is cost of production. We want this item called cost of production. Net works cost slash cost of production. How much is the opening work in progress? 60,000. Closing is 1 lakh. You get 15 lakh 40. Add opening FG, less closing FG. Cost of goods sold. What is the opening FG figure? 260. Closing is 3 lakh. COGS 15 lakh. Then we'll have other overheads like admin expenses, selling expenses, cost of sales, profit, and then sales. Admin, selling, cost of sales, profit, and sales. We'll need the cost of sales figure also for some purpose. How much is the admin expense? 175. Selling is 75. 17 lakh 50. And the profit figure given is matching here, 250. Depreciation is not there. In case it's there, then we have to decide whether total approach or cash cost approach. Any doubts in this? Clear? Now, right, raw material days is equal to raw material days is equal to, like we were doing it in the ratio analysis, average raw material by RM consumed into average raw material by RM consumed into RM consumed into 360, 365 we decide. I'll take it as 365. Tell me the average raw material, opening and closing average. Opening and closing average. 1 lakh 90. RM consumed is 10 lakh 80. We keep it as 2 decimal. In the end, I'll round off. 64 point. Last question, this was given directly. Here you have to do the calculation. 64.21 days. Raw material is on RM consumed. Same thing now. WIP days is equal to average WIP. After WIP in the cost sheet, you get cost of production. Average WIP by cost of production. 80,000 by 1540. 80,000 is the average. 18 point. FG days is equal to average FG by COGS. Average FG by COGS. 280 by 15 lakh. Just remember what comes next in the cost sheet, that will be the denominator. For raw material consumed. For WIP, cost of production. For finished goods, it is cost of goods sold into 365. 68.13. Debtor days is equal to average debtors credit sales. Average debtors by credit sales. 1,75,000 is the average debtor. Opening and closing. Opening and closing. Sales is fully credit they have given. Divide by 20 lakh. Divided by 20 lakh. How many days? 31.94 days. And finally creditor days. Finally creditor days. Creditor days. Average creditors by credit purchases. Average creditors is 2 lakh 20. Credit purchases is 11 lakh. How many days? Please now tell me the operating cycle. Add all the 4, deduct 73 and round off. Now you can round off. 64 plus 18 plus 68 plus 31 minus 73. Finally round off and tell me the figure. Operating cycle. How many days? Sorry. 110 days. Operating cycle 110 days. So it is taking 110 days for us to convert the cash back into cash. For converting the cash back into cash, it's taking 110 days. Any doubts on this? Next, working capital requirement is equal to annual cost into 110 by 365. Annual cost is cost of sales. That is where the cost sheet cost of sales will help. Annual cost into 110 by 365. 110 by 365. What's the annual cost? 17 lakh 50,000 into 110 by 365. 5 lakh 397. 527 397. Any doubts on this? Clear? So this was doing individual estimation line by line. This was doing operating cycle method where we were calculating the time taken to convert the cash back into cash. Now we are going to get into something called as individual estimation or line by line estimation, which is more accurate method. The other one was a shortcut approach. This is an accurate method. In the accurate method, we'll have two types of question, one for an existing company, one for a new company. There will be subtle difference between the two. Go through question 3. The below information for Lever Limited is provided on annual basis. Sales, material consumed, wages paid, cash expense, admin sales. Company sells its product at a GP of 20%. Company keeps 2 months stock of raw material, 2 months stock of finished goods. Depreciation is part of COP. Cash balance. Compute the working capital on cash cost basis. They've asked on cash cost basis. If it's on cash cost basis, depreciation assets doesn't make any difference. They've asked on cash cost. Question does not talk about being a new company. So it's an existing company. We'll first prepare a cost sheet. In the cost sheet, if it's an existing company, one implied assumption is the opening raw material is equal to closing. So we are going to do this cost sheet again. But we will not write opening raw material, closing raw material because assumption is both are same. Opening WIP, closing WIP, both are same. Opening FG, closing FG, both are same. That's the assumption with which we are going to do. And they are asked us to follow something called as cash cost approach. Again, write cost sheet first. Cost sheet. Particulars calculation amount. First item is raw material consumed slash purchased. All are same. Raw material consumed or purchased, all are same. No opening raw material, no closing raw material. What's the direct material figure? 12 lakh. RM consumed slash RM purchased. What's the next item given? Direct wages. They have said wages paid, 1 month lag in payment. which means 11 month of current year and 1 month of the prior year. So wages paid is 12-month expense only. Last year also there would have been something in arrear, because what we normally take is wages accrued, not wages paid. But the point here is wages paid 1 month lag in payment. This 1 month lag in payment means current year 1 month will be paid in the next year, and last year 1 month would have been paid in the current year. So wages paid as it is 9 lakh 60, 9 lakh 60 was the next item given. Manufacturing expenses 12 lakh. If I had done total approach, depreciation would have come as the next item. Okay, here we are doing cash cost approach, so depreciation will not come. The total is GWC, NWC, COP, COGS. Gross works cost, net works cost, COP, COGS. GWC, NWC, COP, COGS. What's the total you get? Now listen. Question has said GP margin is 20%. So COGS should ideally be 48 lakh into 80%. That gap, whatever you see, is the depreciation. We are not writing depreciation here because it said company keeps 2 months stock, 2 months stock. Depreciation is part of COP. Depreciation is part of COP, and I am not writing depreciation as a line item. In case I was to follow total approach, COGS figure will be 80% of 48 lakh. 80% of 48 lakh, and depreciation will be balancing figure. After this, next item, admin expenses. Admin expenses 360. Sales promotion expenses 120. Cost of sales, that's all. No profit, nothing we will write. We just stop at cost of sales. Technically called as cash cost of sales. This is. What's the number you get? 38 lakh 40,000. Under cash cost approach, we don't write depreciation, we don't write profit. 38 lakh 40,000. This is the most important part, getting the cost sheet right. Once that is done, balance is just a formality. Any doubts on this? Working note to estimation. Estimation of working capital. Particulars calculation amount. Estimation of working capital. Point number 8, current assets. Leave some 7-8 lines for current asset. And then point number B, current liability. We'll read every line item of the question, and that will lead to some current asset or current liability, and we'll do the estimation of that current asset. But starting is always cost sheet, because that will give us the base information to do the estimation. Current assets and current liabilities. Sales at 3 months credit. This will lead to debtor. Sales at 3 months credit. But you cannot, if it was total approach, we will do sales into 3 by 12. Cash cost approach, you will have to do cost of sales into 3 by 12. First is debtors. Debtors 38 lakh 40,000. 38 lakh 40,000 into 3 by 12. Total approach means sales into 3 by 12. Here it is cost of sales. 3840 into 3 by 12, 3 months. How much? 9 lakh 60,000. sales at 3 months credit. Material consumed, suppliers give 2 months credit. This will lead to what? Suppliers are giving 2 months credit. Creditors 1 lakh into 2 by 12. Into 2 by 12, 2 lakhs. Wages paid 1 month lag in payment. What will this lead to? Outstanding wages. Outstanding wages. 1 month lag. 9 lakh 60 into 1 by 12. Outstanding wages 80,000. What's the next item? Cash manufacturing expense paid 1 month on. It should be paid 1 month in arrear. Paid 1 month in arrear. Outstanding manufacturing expenses 1 month delay. Outstanding manufacturing expenses 12 lakh into 1 by 12. Outstanding manufacturing expenses 12 lakh into 1 by 12. Twelve lakh into 1 by 12. Next is administrative expense 1 month lag in payment. Admin expense 1 month lag in payment. Outstanding admin expense 3 lakh 60 into 1 by 12. 30,000. 360 into 1 by 12, 30,000. Any doubts on this? Next item is prepaid sales promotion. Prepaid sales promotion. Monthly in advance 1 lakh 20. 1 by 12. 1 month in advance 10,000. Company sells its product at a GP. Company keeps 2 months stock of raw material. 2 months stock of raw material. As you read a line, you'll have to keep writing the current asset and current liability. Stock of raw material. What is the RM consumed figure? 12 lakh into 2 by 12. 2 by 12. 12 lakh into 2 by 12. How much? 2 lakhs. Then stock of, next is stock of FG. FG is on COGS. FG is on COGS. What is the COGS figure? 3360. 2 by 12. 3360 into 2 by 12. How much? 9 lakh 60. 5 lakh 60. 3360 into 2 by 12. 5 lakh 60. Then the next item is cash balance is there. Cash is how much? 1 lakh. Tell me the total. Total current asset. WIP is not there, which is a very tricky adjustment, but in this question it's not there. Total current asset 18 lakh. 18 lakh 30,000. Total current asset 18 lakh 30,000. Any doubts on this? Total current liability. Very simple. Every item you have to estimate, put a total. Total current liabilities. How much? 4 lakh 10,000. Working capital 1830 minus 410. 14 lakh. On top of this, there can be something called as a safety margin, because I estimated this, but I may go wrong. So I want to be a little bit safer, and there is a safety question I want to add on my estimation. 14 lakh 20 is the working capital requirement. Any doubts in this? Add safety margin. How much is the safety margin? Assuming a 15% margin, 1420 into 15% is the safety margin. 2 lakh final working capital. 16 lakh 33,000. Any doubts in this? 16 lakh 33,000. Clear? Okay. I'll take a break at this stage. The fourth question will take a lot of time. So we'll take a break. We resume again by 150. I'll resume by 150. Okay, let's continue with the discussion. We have done, I think, one question on estimation. We'll try to do few more questions on estimation, and post that we'll take a call as to what we can complete. Go through question 4. Very good problem. Go through this. Okay, they've given first a broad cost sheet they have given. We'll have to prepare a detailed cost sheet, and it's again an existing company. There's no reference of a new company being made. So we are required to find out the working capital again on cash cost basis. If the budgeted level of activity is 1,50,000 units for the year, first thing we'll do is prepare a cost sheet for 1,50,000 and then start estimating every item. Working note 1, cost sheet. Cost sheet for 1,50,000 units. Particulars calculation amount. In this raw material, we'll have to segregate item wise because estimation will be different for every item. Raw material X, raw material X, 1,50,000 units into 1,50,000 units into how much it is? 30. 1,50,000 into 30, 45 lakhs. raw material Y is equal to 1,50,000 into 7, 10 lakh 50. Raw material Z is equal to 1,50,000 into 6, 9 lakh. Direct labor 1,50,000 into 25, 37,50,000. Manufacturing and admin they have given club together. They have not given breakup. Manufacturing and admin will come above COGS. If it was admin and manufacturing, below COGS would have written manufacturing and admin, mainly manufacturing expense and admin 1,50,000 into 20. GWC depreciation will not come. COGS. Depreciation will not come in the calculation. Cash cost approach. Total of all of this is GWC, NWC, COP and COGS. How much? 1 crore, 32 lakhs. Then we have selling overhead 1,50,000 into 15. Cost of sales 1 crore 54 lakh 50,000. Cost of sales 1 crore 5450. One crore 54 lakh 50,000. Clear? Any doubts on this? This is the cost sheet and the cost of sales is 1 crore 54 lakh 50,000. Now we'll have to do the estimation, and estimation will be different for different item. The main discussion is going to be on WIP estimation, and that's the reason we are doing this question. Working note to estimation, estimation of working capital, particulars calculation amount, same current asset, current liability, current assets, leave some, I think you will need at least maybe 10 lines kind of thing, and then current liability, current assets and current liability, current assets and current liabilities. We'll go item by item, keep estimating them. In the cost sheet is there below. Raw material have different credit periods. So creditor for raw material X, creditor for raw material Y, creditor for raw material Z, all the three are going to be different. Calculate and then you can refer the screen. Creditor for raw material X, Y and Z. 45 lakh into raw material X is 2 by 12. 45 lakh into 2 by 12, 7 lakh 50. Raw material Y is 10 lakh 50 into 1 by 12. What's the answer? 10 lakh 50 into 1 by 12? 87,500. And raw material Z is 9 lakh into 0.5 by 12. 37,500. Clear? Stock of WIP. This is where major time will get spent. Stock of WIP. Stock of WIP. Leave some space and come down. Note 1, stock of WIP. Stock of WIP. WIP is based on COP. Tell me the COP number. 1 crore. Now listen. Ideally what we do is we break it into two parts, material cost, others. The issue with WIP estimation is COP means it is a finished product. Production means it is fully produced. WIP is something which is incomplete in nature. So when it is incomplete in nature, I need to attach a degree of completion for every item. The rule says raw material cost into half month into 100% degree of completion. Other cost into again half month into 50% degree of completion. 100% for material, 50% for others. Here it says production requires full unit of X and Y in the beginning. Full unit of X and Y in the beginning means 100% complete. 100% complete. Z is required only to the extent of half in the beginning. Half in the beginning means 50% complete. And by the time it gets over, it will become 100% complete. And remaining half is needed at uniform rate during the production process. They have not mentioned anything about direct labor and manufacturing expense. Break this cost into 5. X, write separately all of them. X, Y, Z, direct labor and overheads. This can be clubbed together. X, Y, Z, direct labor and overheads. Direct labor and overheads. How much is the material X cost? 45 lakh. I'll write the into in some time. Y how much? 10 lakh 50. Z 9 lakh. Labor and overhead put together 67. Ideally what we do is we just break it into material and others if problem is silent. Now in this write into 0.5 by 12 into 0.5 by 12 into 0.5 by 12 into 0.5 by 12. This one 100% complete. 100% complete. Last one silent 50%. Labor and overheads we take 50%. Material we take 100%. In this question labor and overhead it is silent. What is 50%? Is 0 starting, ending 100, average is 50. Starting 0, ending 100. Material Z starting is 50, ending is 100, average is 75. Starting is 50, ending is 100. Material X starting 100, ending 100, average 100. Material Y starting 100, ending 100, average 100. Material Z starting with 50, ending with 100, on an average 75. On an average 75. And direct labor and overhead starting with 0, ending with 100, on an average 50%. Do each of this and tell me the figure and then the final total. Each of this you have to estimate and then the final total. 45 lakh into 0.5 by 12 into 100%. 187 500. 10 lakh 50. 43 750. 28 125. 140 625, and total of all of this is the work in progress. 100% and 50% is the rule. 100% and 50. Problem silent 150. This question has mentioned certain numbers. How much? 4 lakhs. Note 1. This is the main calculation. Balance is just a formality. Main is work in progress. 4 lakh rupees. Any doubts on this? Clear? 100% for material, 50% for others. If problem silent. Material X we have taken 100%. Start with 100, end with 100. Material Y start with 100, end with 100. Material Z start with 50, end with 100. And labor and overhead start with 0, end with 100. Average degree of completion. Others you keep doing it then. WIP is done. Stock of material X. 45 lakh into 2 by 12, 2 months stock. Stock of material X, stock of material Y and Z, 19 lakh 50,000 1 month. Material X is 2 months, Y and Z is 1 month. 162 500. Stock of FG. FG is on COGS, no degree of completion. All that headache is not there. When we do WIP alone, this degree of completion comes into picture. What is the stock of, what is the COGS figure? 1 crore 32, no? Into 1 by 12. 1 crore 32 into 1 by 12. Clear? Debtors 1 crore 54 lakh 50,000 into on cost of credit sales. On this 1 crore 54 lakh, it's not on sales, it's on cost of sale. 1 crore 54 lakh 50,000 into what the question says is 25% is cash sales and balance is credit sale. 25% is cash sales, so into 75% into 2 by 12. 75% and then 2 by 12. 19 lakh 31 250. Debtors 19 31 250. Clear? Debtors is 19 31 250. Then we have outstanding overheads. Outstanding overheads. Lag in payment of all overheads. All overheads put a total into 1 by 12. Lag in payment of all overheads. Outstanding overheads from the cost sheet. Overheads is 30 lakh plus 22 lakh. Manufacturing admin 30 lakh. Selling overhead 22 lakh. Outstanding overheads 50 to 50 into 1 by 12. 50 to 50 into 1 by 12. How much? 437 500. Outstanding wages. Outstanding wages half month. Lag in payment of all overheads is 1 month. Wages is half month. 3750 into 0.5 by 12. 1,56,250. Cash balances. With this problem gets over, you can complete it later. Okay, total current asset, total current liability, current asset minus current liability, add the safety margin. All that I don't want to spend time because that is just a calculator work. Any doubts on this? The main part was the WIP estimation. Any doubts on the WIP estimation part? Clear? Can we proceed? Any doubts on this? Go through 5. Management of MNP companies planning to expand its business consult you to prepare an estimated working capital statement. Records reveal sales, domestic, export, material, wages, manufacturing expense, admin. Rate of GP is 20. Ignore work in progress and depreciation. So there is no work in progress, there is no depreciation. You are required to estimate the working capital requirement. They have not told whether it is total approach, cash cost approach. If it is silent, you will have to take an assumption. Solution is under total approach, so we'll do total approach. I can do cash cost also. Whatever we are taking, you'll have to write a note and then proceed it. So we are going to do this under total approach. First thing is obviously the cost sheet. Once the cost sheet part is done, then we'll try to do the balance part. Let's do total approach. Cost sheet under total approach. Cost sheet under total approach. Particulars calculation amount. Under total approach. Particulars calculation amount. Again, it is an existing company. What's the first item? Direct material. Direct material, or you can say raw material purchased slash consumed. Focus is on the cost sheet only. Purchased slash consumed. How much the raw material purchased or consumed? 9 lakh. Very similar to the first question we did. 9 lakh. Wages. How much the wages? 7 lakh 20. Then we have manufacturing expenses, 10 lakh 80. Manufacturing expense 10 lakh 80. Now in the question, be little cautious whenever GP is given. Whenever GP is given, first question also GP was given, but their depreciation was there, and we were doing cash cost approach. We ignored the depreciation. Here, this GP may lead to some hidden cost in the question. What is the hidden cost and all? I don't know. You'll understand as we proceed. Leave a line gap in case any hidden thing comes. GWC, NWC, COP, COGS. GWC, NWC, COP, and COGS. Now, question says my GP margin is 20%. GP margin is 20%. That is possible for domestic sales. Export, what is happening? It is sales prices 10% below the domestic price. The sales price is 10% below the domestic price. Leave some space for the cost sheet and come down. Come down. Domestic sales, particulars, domestic, export. Sales 24 lakh, 10 lakh 80. COGS is 80% of this. Into 80 by 100. 80% of sales. 80% of sales. Clear? But export, what will happen? Listen, 10 lakh 80 into 80 is right. But the selling price is not. See, I am reducing the selling price. When I reduce the selling price, cost price cannot go down. Cost is 80, sales is 100 for export. Cost will be 80 only, but sales will be 90 now. The sales will be 90 because your price is 10% below the domestic price. So that same GP margin will not hold good here. 80 by 100 and this side 80 by 90. 80 by 90. 80 by 90. How much is the COGS number? 9,60,000. Put together, what is the COGS? 1920 plus 960. 28 lakh. I'll repeat again. Domestic into sales into 80 by 100. Export sales into 80 by 90 because of 10% discount. 10% discount. 28 lakh. In case, see, the question said ignore depreciation. If that word was not there, depreciation is balancing figure. Any balancing figure are you getting? Other expenses, we don't know the expense also. What is that expense? We don't know. Other expenses, balancing figure. 1 lakh. If I don't write this, my stock of WIP, stock of FG, everything will get wrongly estimated. So COGS is 2880. This adjustment I should have done even in the first question. Their COGS would have been 75% of sale and depreciation would have been the balancing figure. But in that question we ignored it because they said cash cost approach. Here we are doing total approach. Even if I do cash cost approach, this will come because depreciation is to be ignored as per the question. So depreciation is not there. What is this item? We don't know. It could be maybe direct expense. It could be some allied expense. We don't know. Balancing figure, we left it. After this, admin expenses. Admin expenses, how much? 2,40,000. Admin expense 2,40,000. Selling expenses 1,50,000. Cost of sales, profit and sales. Cost of sales, profit and sales. Cost of sales, profit and sales. What is the cost of sales figure? Sales figure is profit balancing figure 2,10,000. Main part is always getting the cost sheet correctly. Any doubts on this? Estimation, we are not. Okay, I'm going to discuss estimation. I don't see a need for you to write it. Writing will take away time, but some points I have to discuss. First is sales domestic at 1 month credit. We are doing total approach. 24 lakh into 1 by 12 is debtor. 24 lakh into 1 by 12 debtor. Then 10 lakh 80 into 3 by 12 into 3 by 12, 3 months credit. 9 lakh into 2 by 12 creditor. 9 lakh into 2 by 12 creditor. 7 lakh 20 into 0.5 by 12 into 0.5 by 12, which is outstanding wages. 10 lakh 80 into 1 by 12 outstanding manufacturing expenses. 2 lakh 40 into 1 by 12 outstanding administration expense. What should I do with sales promotion? Asset liability. Participate guys. Sales promotion, is it an asset or a liability? Asset. Sales promotion payable quarterly in advance. Prepaid sales promotion 1,50,000 into what? 1 by 4. 1 by 4 quarterly in advance. 1 by 4. Same way income tax payable 4 installment. 1 falls in the next financial year. So 3 installments I have already paid. 1 installment payable 2,25,000 into 1 by 4 into 1 by 4 is the income tax payable. Rate of GP, okay. 1 month stock of raw material. 1 month stock of raw material is 9 lakh into 1 by 12. 9 lakh into 1 by 12. 1 month stock of raw material and finished goods each. 1 month finished goods also. For finished goods, you will have to use COGS. COGS. So if you had not taken that 1,80,000, COGS would have been wrong. And if COGS is wrong, estimation would have gone wrong. So 28,80,000 into 1 by 12. All this is fine. Tell me what should I do with this item? This is the reason I'm discussing this. That's all. Otherwise, I would have told you do later. What should I do with this item? Current asset, current liability, and how much should I write? Okay, anything else? It says believes in keeping 2,50,000 available to it, including the OD limit of 75,000, not yet utilized by the company. What does believes in keeping is I need a cash of 2,50,000, but I don't want to keep it as cash. 1,75,000 I'll keep cash. Another 75,000 is an overdraft limit which is not even utilized by me. If it was utilized, then I have to keep full cash. If I have not utilized, what I can do is I can keep lower cash, and whenever there is a need for money, I can use the OD limit. I need 2,50,000. So my parents are saying you keep 1 lakh with you. Anytime you come back to us, we will give you 50,000 rupees. So I have a limit available from my parents. Similarly, there is a limit available from the bank. Bank is saying anytime you can withdraw 75,000. So I keep a cash of 175. OD as of now is 0. If OD was used, bank OD 75,000 and cash would have been 2,50,000. Cash would have been 2,50,000. Any doubts on this? Clear? Go through this question. Okay. First line crystal clear, a newly formed company. In a newly formed company, I'll have to do a detailed cost sheet where opening raw material 0, opening WIP 0, opening FG 0, closing there will be a value. Keeps you're requested by the bank to prepare an estimate of the working capital requirement. They have given a cost sheet to us, but it's in a slightly different format. They've given in an income statement, and this is the breakup of their cost sheet: material, wages, depreciation, stock of FG. The figures given above relate only to the goods that have been finished and not to work in progress. So this whatever they've given is technically wrong. They have given the statement only for goods that have been finished and not related to the work in progress. You incur raw material cost not only for goods finished, you also incur it for work in progress. Goods equal to 15 percentage of the year's production. 15 percentage of the year's production are in progress on an average, requiring full material, 100% material, 40% other expenses. 100% material, 40% other expense. If problem was silent, 100% material, 50% others. Company has some 2 months consumption of material and stock, cash balance, lag in payment of all expenses, supplies give, sales is 20% cash, 70% income tax has to be paid in advance. I have to estimate on cash cost basis. On the cash cost basis, first thing is let's do the cost sheet properly. Once the cost sheet is done, estimation if needed only we will do, else I'll discuss it. Main part is only cost sheet. Let's do the cost sheet here. Cost sheet of newly formed company. Particulars calculation amount. Direct material, underline that. Opening RM, add purchases, less closing raw material consumed. Opening raw material, add purchases, less closing raw material consumed. Opening raw material is zero. It's a newly formed company. No concept of opening raw material. Opening RM zero. Now, ideally RM consumed is 8 lakh 40, but there is a problem. The problem is they have said the above statement is only for the goods which have been completed. Have they mentioned how many units have been completed? Any data on number of units? Any information on number of units? So I take number of units completed as 100. 100 is the units completed, which means 15 is work in progress. 15 is work in progress. 100 got completed, 15 is work in progress. And every unit raw material cost is 8,400 rupees. 8 lakh 40,000 by 100 units. 8 lakh 40,000 by 100. Now the problem for me is, right, RM consumed 8 lakh 40 plus extra cost 8 lakh 40, extra cost is 8 lakh 40, divide by 100 units, extra 15 units, and these 15 units 100% degree of completion. 8 lakh 40 8 lakh 40 and extra is 8 lakh 40 by 100 into 15 units into 100% degree of completion. All put together how much? Whatever we are adding will be removed at some stage, that also I'll explain. 9 lakh 66,000. In the cost sheet itself, we'll estimate closing raw material. RM consumed into some stock holding period they would have given. 9 lakh 66,000 into stock of raw material for how many months? Stock of raw material is 2 months, so into 2 by 12. Stock of raw material into 2 by 12. Purchases and consumption will not match now. Purchases and consumption will not match. 966 into 2 by 12, how much? Purchases balancing figure. Purchases balancing figure. Sorry? 1127. Any doubts on the raw material consumed figure? I had to add back this. If I don't add back, my closing raw material will go wrong. Estimation will go wrong. Next, direct wages. Direct wages. 6 lakh 25 plus 625 divide by 100 into 15. 625 by 100 into 15, but it's not 100% complete now. It's not 100% complete. How much it is complete? Into 40%. 40 plus? No, they've directly given the degree of completion. 40% is directly given in the question. There they said initially starting with 50, ending with 100, starting with 0, ending with 100. Here they very clearly mentioned goods is work in progress, which will need full material, but only 40% of other expenses. They have given the degree of completion here. How much is the figure? 6 lakh 62, 662 500. Was the next item given? Depreciation 0. I cannot write cash cost approach. Else the same thing. Here also you have to do divide by 100 into 15 into 40%. You'll have to add. You will have to do the same thing again. Depreciation also will be divided by 100 multiplied with 15 into 40%. This total is called gross works cost. Gross works cost. Gross works cost. 16 lakh. Add opening WIP 0 less closing WIP. Net works cost or COP. Add opening WIP less closing WIP. Now what is closing WIP is whatever you added here. This part is the WIP value plus this part is the WIP value. Whatever you added is the work in progress component. Is the work in progress component. Whatever was added by us, now I will remove it also. I added it, I am removing it also, so that whatever COP is given in the question, it will match. We added and now we are removing it as well. Why did we add? To do correct estimation of material consumed, correct estimation of closing raw material, correct estimation of purchases. 8 lakh 40 by 100 into 15, 625 by 100 into 15 into 40%. Tell me the figure. 163 500. 163 500. We have to add it as well as remove it. What is the networks cost figure? 14 lakh 65,000. 14 lakh 65,000. 14 lakh 65,000, which is nothing but as given in the question. In the question, if you see, it's nothing but 840 plus 625. 840 plus 625. Depreciation will not come, else it would have become, total would have become 17 lakh. If you had done total approach, here you would have got 17 lakh as the COGS number. From there, FG is 10%. Earlier it was on 17 lakh, now it is not on 17 lakh because we are doing cash cost approach. Add opening FG 0 less closing finished goods 10%. Cost of goods sold 13 lakh 13 18 500. COGS 13 18 500. 13 lakh 18,500. Any other expense given in the question? Admin expense 140. Selling expense 130. Cost of sales. With this, the cost sheet gets over. You're doing total approach or cash cost? What is approach? Cash cost too. With this, the cost sheet gets over. Cost of sales 1588 500. Now we'll have to do the estimation part. One good thing about a new company is we have already estimated 3 items. Stock of raw material is done. Stock of WIP is done. Stock of FG is done. Other things we will start estimating. Any doubts on the cost sheet? Most important part, I had to add back the WIP component because it was not considered in the calculation, and then I removed it also. Added back and then removed it as well. Next, working note to estimation. Estimation, right. Estimation of working capital. Estimation of working capital. Particulars calculation amount. Current assets. 7-8 lines gap. Current liabilities. Current assets and current liabilities. Current assets and current liabilities. In the current asset, first write three items: stock of raw material, stock of WIP, stock of FG. All the three are estimated by us. It is there in the cost sheet. All the three are already done. Stock of, if I don't add work in progress, all these three could have gone wrong. That is the purpose of adding that. Stock of raw material, how much? 1 lakh, 1,61,000. Stock of WIP, 163,500. FG, 46,500. Raw material WIP and FG, 161, 163 and 146. Raw material WIP and FG. Apart from this, let's start estimating items. In the beginning, we don't have anything. In the below, figures given above relate only to the goods that have been finished, not to work in progress. Goods equal to 15% in terms are on progress. Full material 40%. Company believes in keeping 2 months consumption. Desired cash balance, right? Cash 40,000. Desired cash balance 40,000. Average time lag in payment of all expenses. All the expenses you have to add, and then the average time lag is 1 month. Average time lag in payment of all expenses is 1 month. Outstanding expenses. Outstanding expenses. Outstanding expenses. All the expenses 662, 1,40,000, 1,30,000. All expenses put together. Time lag in payment of all expenses is 1 month. 662, 140 and 130. 662, 500, 140 and 130 was the total. 9 lakh 32 500 into 1 by 12. 932 500 into 1 by 12. 7 not 77 708. 932 500 into 1 by 12. 77 708. Clear? Then we have suppliers give 1.5 month credit. Creditors, this is on purchases. Purchases is different, consumption is different now. Creditors is on purchases. Purchases figure will be different. What is the purchases figure? 11,27,000. 1127 into how many months? 1.5 by 12. 1.5 by 12, how much? 40,875. Any doubts on this? Then they have said applies sales are 20% cash, rest are at 2 months credit. Sales is 20% cash. Sales is debtor on cost of sales. On cost of sales. Next, debtors 1588 500, 500 into 80%, 2 by 12, 2 lakh 11,800, 211,800, 211,800. Debtors figure is 2 lakh 11,800. Any doubts on this? Clear? 70% of the income tax has to be paid, which means 30% is unpaid. 30% is unpaid. The unpaid portion is 1 lakh is the provision for tax. 70% has been paid by us. 30% is unpaid. Income tax payable 1 lakh into 30%. Clear? I'm not putting total of current asset, current liability, all that I don't want to do. I've done the estimation. Is there any safety margin part is not there? So you just need to get the final answer. I don't want to spend time on that. Okay, we are going to do 7, but I'm not going to do this question. Almost the similar question, but I think there is some gap in this problem. I was just looking at it in the break. This is the question we are going to do. It is going to be similar to that, but you read this question. Almost similar to that. I'm not sure if numbers will match, but see this question. Don't see that. See this. Okay. Focus will be on doing cost sheet. After cost sheet is done, estimation I may do, may not do, depending on if I feel something very tricky, we will do estimation. Otherwise, cost sheet is what our focus will be. A day limited, a newly formed company. So it is a new company and they want estimation to be done under cash cost basis. Very similar to the question we did. The only difference here is here they have given the number of units. There they said did not give 100 units. We took 100 and 15 was the work in progress. Here completed number is 31 to 100. Work in progress is 12,000. Degree of completion is given 100%, 50%. Material is 100%. Conversion cost others is 50%. So this is the degree of completion we are going to follow and then do the cost sheet. Let's start cost sheet. Cost sheet. Open the cost sheet. Particulars calculation amount. Focus would be to get the cost sheet done properly, and then I think we'll discuss if needed, we'll solve it. Direct material, opening raw material, add purchases, less closing raw material, RM consumed. Opening raw material, add purchases, less closing raw material consumed. Opening is 0. First, we always write consumption. Now, listen, consumption is 31,200 units into 40 rupees plus 12,000 units into 40 into 100%. Whatever this extra 12,000, this will become work in progress. This will become work in progress. Whatever that extra add on is there, that will become closing work in progress. So 31,200 into 40 plus 12,000 into 40 into 100%. 100%. 17 lakh 28,000. Raw material consumed 17 lakh 28,000. Based on 1728, we will do closing raw material. Purchases will become balancing figure. Exactly same thing we did in the previous question. Same here also. 1728 into in the question, the raw material stock is 30 days consumption. 30 days consumption, 360 days they have told in the question. 30 by 360. 30 by 360. How much? 1 lakh 44,000. Purchases balancing figure 18 lakh 72,000. This is on direct material side. 18 lakh 72,000. Even the question which is there is almost similar, but there they have done one complication unnecessary, and I see some logical gap, so that's why I'm avoiding that question. 1872. Direct wages 31,200 into 15 plus 12,000 into 15 into 50%. 50% only for wages. Five lakh 58,000. 31,200 into 15 plus 12,000 into 15 into 50%. Clear? Overheads, we are following cash cost approach again in this question. 40 per unit including depreciation. Ignore the depreciation component. Including depreciation, 30 per unit. 30 per unit. Gross work cost. Gross works cost. 34 lakh 2,000. Now, whatever extra add-on we did, we are going to remove all that and we will get COP number. The add-on is that extra 12,000 units, whatever we added, we are going to remove that as closing work in progress. 34 lakh 2,000. Any doubts on gross works cost? Add opening WIP. 0. Less closing WIP. Less closing WIP. 12,000 into 40, 12,000 into 15 into 50%, 12,000 into 30 into 50%. Under total approach, even depreciation would have come into calculation. Whatever extra add-on we did, we are removing it. That we are removing that now. 7,50,000. Net works cost. This is net works cost or COP. This is for 31,200 units. 31,200 units. Do 2652 divide by 31,200. 85, which is nothing but 40 plus 15 plus 30 rupees. 40 plus 15 plus 30 rupees. 85 rupees is the cost per unit. 85 rupees is the cost per unit. We added, we removed, we added and we removed it. Finished goods stock 24,000 units is there. So after this, add opening FG 0, add opening FG 0 less closing FG 24,000 units into 85 rupees. 24,000 units into 85 rupees. Twenty lakh 40,000. Any doubts on this? We added the WIP portion, removed the WIP portion. I get cost of goods sold. This is for 7,200 units. This was 24,000 units. It will technically match 7,200 into 85. 7,200 into 85. I think cost sheet is over. My main discussion is over. I do not have other expenses in this question. So this is COGS slash COS, no profit, no sales, cash cost approach. If estimation is needed, we will do it. Otherwise, we are kind of done with the question. Any doubts here? Any doubts in this? Now let's see the question. It talks about projections, estimated level of activity, raw material, direct wages, overhead, selling price, raw material estimation completed, WIP estimation completed, finished goods completed, creditor is purchases into 30 by 360, purchases into 30 by 360, credit allowed to purchaser, purchaser is my customer, credit allowed to purchasers, cash cost of credit sales into 60 by 360, into 60 by 360, outstanding wages is into 15 by 360, cash as it is and the estimation is over, cash as it is and the estimation gets over. Any doubts in this? Again I'm repeating, for a new company you have to first write opening RM, closing, opening WIP, opening FG, all the three will be 0. Closing we will do estimation and copy paste the same in the next working note. Any doubts in this? Ignore this question. There are some gaps in the question, so ignore this. And this question, whatever I discussed, is there in the edition 3. Edition 3, page 286. In case you want to refer later, edition 3, page 286. Go through question 8. Okay, MN Limited is commencing a new project for manufacturing of electric toys. So, new project they are doing. It's like a new company. Following cost information, I'll have to do a cost sheet. After cost sheet is done, in the estimation side, we'll see what needs to be done. One good part, I think WIP is not there in this question. So, we just need to keep writing every item and then do the estimation. Let's first complete the cost sheet part. Estimation also I want to discuss one important adjustment here. But first do the cost sheet. You do in your notebook. I am doing it on the screen. You refer in case you get a doubt. Be a little cautious. You do the cost sheet. Refer the screen once you are done. Be a little cautious about the cost sheet estimation. The cost sheet is done under total approach. So you do total approach itself. There also one adjustment is there. Do total approach. Your fixed manufacturing overhead will be 60,000 units into 10 at full capacity. It is at full capacity. That be little cautious. This should be the cost sheet. Be little cautious on your fixed expenses. Closing FG is 5,000 units. This chapter needs little bit of good grip on cost sheet chapter of costing, else struggle will be there. Any doubts on this? Now I will start discussion. If needed, we will do estimation. One main adjustment I want to discuss. My focus is always on the cost sheet. We did one existing company full estimation, new company one full estimation we did. Others we have been doing cost sheet only. Any doubts on this? Now, if I look at the requirement, stock of raw material done, credit allowed for debtor, debtors are taken at cost. Debtors are taken at cost. So we will do cost of sales into 1.5 by 12. Cost of sales into 1.5 by 12. Credit allowed by creditors, purchases into 4 by 12. Lag in payment of wages, wages into 1 by 12. Lag in payment of overheads, you will have to add variable manufacturing overhead, fixed manufacturing overhead, variable selling overhead, fixed selling overhead. Variable selling overhead is on units sold on 35,000, not on 40,000. On 35,000. Variable selling overhead is on units sold. Then cash is given. All this is done. Once I do estimation, we get 449,792. Beyond this, I want to discuss one more adjustment. 449,792 is the working capital requirement. If you keep estimating every item, 449,792 asset minus liability. One more discussion now, right? Working capital, right. Estimation part, right? Only one thing. Estimation, particulars, amount, particulars calculation amount, current assets 8,90,000, current liabilities 440,208. 440,208. Working capital 449,792. Beyond this, I want to discuss one item. 449,792. Question says the provision for contingency is 10% of the working capital requirement, including that provision. Normally, contingency is on the working capital figure. Whatever you calculate, add 10% of that. Here they are saying working capital is 10% of the working capital requirement, including the contingency or including the provision. Now, right, add provision for contingency. Add provision for contingency. Final working capital requirement. Add provision for contingency. Final working capital. This number is 100 and on this contingency is 10 and what we calculated is 90. Normally on the working capital you will add the contingency figure. Final amount is 100, contingency is 10 and the base amount is 90. If 90 is equal to 449,792, 10 equal to question mark. 90 equal to 449, 10 equal to question mark. 49,977. 4,99,760. On the final number, I should get 10%. That's how the question has said. On the final number, it is 10%. 499,769. Any doubts on this? Clear? Can you proceed? This question did not have adjustment as far as your working cap WIP is concerned. So that becomes a little simpler. Go through 9. Okay, it is combination of an existing as well as a new kind of a question. Marks Limited is launching a new project for the manufacture of a unique component at full capacity of 24,000 units. The cost is as follows: material, labor, manufacturing and admin, depreciation, selling price is 200, selling expense, production and sales is given. One good part is there is no work in process in the question, it is nil. You are required to prepare a statement of profitability, and working statement of profitability is nothing but cost sheet. In the cost sheet, profits will come, and a working capital requirement for the 2 years based on total approach. We are not going to do working capital requirement. We are just going to focus on cost sheet preparation for 2 years. First year, opening RM will be 0, closing will have a value. Second year, this closing will become opening, and some other closing we may get. So let's start. Cost sheet, statement of profitability, statement of profitability, particulars in 4 columns. Year 1, 2 sub-columns, calculation amount, and similarly year 2. Calculation and amount. Direct material, underline that. Opening raw material, add purchases, opening raw material 0, opening raw material 0. First year raw material consumed will calculate. First year raw material consumed is, what is the production of the first year? 15,000 into 80 is the raw material consumed of the first year. 15,000 into 80, 12 lakh. 15,000 into 80, 12 lakh. Closing raw material is 12 lakh into some period they would have given. How many? 3 by 12. Negative 3 lakh, and purchases is 15 lakh. Clear? Year 2, 3 lakh is opening raw material. 3 lakh is opening raw material. RM consumed is year 2, what's the production? 20,000 into 80. 16 lakh into 3 by 12. Purchases balancing figure how much? How much? 17 lakhs. This takes care of the first estimation or first item. Any doubts on this? Then labor and variable expense. This is fairly simple. 15,000 into 40, 20,000 into 40. Labor and variable expenses 15,000 into 40 and 20,000 into 40. Clear? Now comes the important item, fixed manufacturing and admin. Fixed manufacturing and admin. Fixed manufacturing and admin. It says 40 per, sorry, 20 per unit, but this is what at full capacity of 24,000. At full capacity of 24,000. This is what you did in the previous adjustment also, the previous question. 24,000 into 20. And same this side also, 24,000 into 20. GWC, NWC, COP. GWC, NWC, COP. 25 lakh. Sorry, other side is. Any doubts on this? We're almost done with this. Little bit of two adjustments still there. 25, 20 and 31, 20. Any doubts? Add opening FG 0 less closing FG cost of goods sold. Add opening FG 0 less closing FG cost of goods sold. Entire segment revolves around cost sheet chapter rather than working capital adjustment. It's more of cost sheet focus. Closing FG is 25 lakh 20,000 divided by 25 20 divided by, in the first year we have produced 15,000 units and sold only 14,000. 1,000 is closing stock. Sold only 14,000. Produced 15, sold 14,000 is closing stock. 1,000 is closing stock. 25 20 by 15 into 1,000 by 15,000 into 1,000. Produced 15,000, sold 14,000. How much is the closing FG? COGS. $23 lakh 52,000. It's again a good problem with decent set of adjustments. Any doubts on 2352? I take this as the opening stock. Second year, what is the closing stock units? How many units of closing stock? It's not 2000. Second year, how many units of closing stock? Participate, guys. 3,000, 20,000 is production, 1,000 opening stock is already there. 1,000 opening stock is already there. Together 21,000 is there. In that 3,000 is closing. In that 3,000 is closing. Now I have to do stock of FG. Stock of FG is taken at average cost. Average cost means weighted average cost method. There's a FIFO method of valuation. There's an average cost method of valuation. We'll see this more when I go to cost sheet. Here write 3120 average cost method 3120 plus 168 divided by 20,000 plus 1,000 into 3,000 units. Into 3,000 units. 3120 plus 168, 20 plus 1 into 3,000. This is weighted average cost method of valuation. I'll discuss when I go to cost sheet. 469 714. $28. Any doubts on this? Next, selling expenses. Selling expenses. It says in per unit 80% being variable. Variable part multiply with units sold. Fixed part multiply with the full capacity. So 8 into 14,000 into 24,000. And 8 into 20,000. 8 into 14 plus 2 into 24,000. Cost of sales, profit and sales. 8 into units sold, 2 into overall capacity. 2 into overall capacity. What is the number? 2352 plus 162, 25. This, which one? Which 20,000? 18,000. Okay, sorry. 8 into 18,000, how much? 192. Total is 30 lakh 10,000 and 18,000 into 200. 36 lakh. Balancing figure is 5 lakh. Any doubts on this? Again, I'm saying in this segment, if you want grip, it is more clarity on the cost sheet. If clarity on cost sheet is there, you'll be able to handle the question. Otherwise, challenges will come. Any doubts on this? Clear? With this, my estimation part, the working capital estimation part, you do it later. Debtors is based on cost of sales. Again, it is based on cost of sales. So it's total approach, but debtors is based on cost of sales. So we are done with individual estimation. We are done with this. In this one segment, which you have to see, there is no, I thought there will be a question on that also, which is how you calculate something called as maximum permissible bank finance. There are three formulae for that. You will have to go through those three formulae and then calculate the maximum permissible bank finance. I'll show you that. Yeah, this concept 9, you will have MCQs in the MCQ book. Again, I'm repeating, every concept will not get discussed in these 120 questions. So this is something which you may have to see. Maximum permissible bank finance computation. Three methods are there. Using the three methods, you'll have to calculate the MPBF part. Now, I'm still left with cash management. I'm leaving the cash management for you to do at home later on, which is optimum cash balance calculation and cash budget. Even receivables we cannot do fully, but I'll do part 6. Part 7 is on factoring. Factoring we will not discuss, but we will do part 6. I'll take a 15 minutes break and then we do the receivables management part. Okay, the initial estimation part is over. Cash management part, as I said, you will do it later at home. Now we are getting into relaxation or tightening of credit terms in receivables management. There's another element of receivables management called factoring, which I'll not be able to touch on in the available time. Let's do this now. Question 13. Go through the question. Okay. Now what we are trying to analyze here is what kind of credit period do we need to offer to customer. When I increase credit, sales go up, profit go up, along with lot of expenses going up. Like expenses like bad debt will go up. If you give credit, debtors will be there in the balance sheet. Against debtor, there will be some loan. So I will have expenses around that. So giving credit has one benefit, increase in sales, and 4 5 disadvantages like bad debt, credit administration cost, collection cost, cash discount. We'll have to see finally which gives best benefit. We go ahead and select that. Is considering relaxing its credit policy and is in the process of evaluating two proposed policy. Today the sales is 50 lakh, turnover is 4 times a year. That is 4 times you're able to rotate the debtors. Technically, the debtor days is 360 or 365 by 4. 90 days is the debtor or 90 days is the credit period. Bad debt is only 1 lakh 50. I need a return of 25% of the investment in new accounts receivable. Variable cost 70%. Now I can change it to option 1 or option 2. Sales will go up, debtors turnover will go down, that is rotation will be lesser now, and bad debt will go up. Let's start evaluation of credit policy. Evaluation of credit policy. Particulars in three options. Existing, option 1 and option 2. Sales less variable cost, less fixed cost, gross benefit. Standardized format, sales less variable, less fixed, gross benefit. Three sales figures are given in the question. Sales is 50 lakh, 60 lakh, 6750, 50, 60 and 6750. Variable cost is 70% of sales. 70% of sales. 47, 25. Any doubts on this? Any fixed cost figure given in the question? 0, 15 lakh, 18 lakh, and 20 lakh 25,000. By extending the credit period, my gross profit is going up. There are four expenses we normally incur. I'll write all the four. In this, only few are there in this question. Less bad debt. Less bad debt, 1 lakh 50, 3 lakh, 4 lakh 50. Less credit admin cost. In this question, it's not there, but as a format, I'm giving you credit admin 0. Less cash discount, again 0. Cash discount is 0. Less interest cost, profit before tax. Technically, net profit before tax. Profit before tax. Come down, note 1, computation of interest cost. Computation of interest cost. Particulars in 3 columns. What is interest cost is debtor figure multiplied with the interest rate which is given in the question. They have said they want some specific return in the question. That's technically interest cost. So if question is silent, some question will say debtors is to be valued on the basis of sales. Some question will say variable cost. Some question will say full cost. Nothing is mentioned. We go with full cost of sales to calculate the debtor figure. Base is not sales. Base is full cost of sales. Point number 1, full cost of sales. What is full cost? Is variable plus fixed. 35 lakhs, 42 lakhs, 4725. Full cost of sales. Debtor turnover ratio 4, 3 and 2.4. 4, 3 and 2.4. If they give credit period into 90 by 360 and if they give ratio, divide by the ratio. This is what we did in ratio analysis. So you divide, you'll get debtors. Debtors is full cost by debtor turnover ratio. And then interest cost, debtors into 25%. 25% return they want. Debtors into 25% return. Deduct the interest cost and you'll get the net benefit or net profit. Interest cost is debtors into 25%. Debtors into 25%. 11 lakh, 31,250, 11 lakh 50,000, 8. We'll go ahead with option 1 that gives us the highest net benefit. We'll go ahead with option 1 that gives us the highest net benefit. Highest net benefit. Any doubts on this? Clear? Can you proceed? Any doubts on this? Highest net benefit comes in option 1. Let's come to this. Almost going to be similar only with some changes here and there. Question 14. Banu Limited is considering relaxing its present credit policy. Process of evaluating two proposed policy. Firm has annual credit sale of 225 lakhs. Accounts receivable turnover ratio is 5 times. Current level of loss due to bad debt is 7 lakh 50. Firm is required to give a return of 20% on the investment in new account receivable. Option 2 requires a manager to manage the receivables with a salary of 50,000 per month. So credit administration cost they are talking about. Variable cost is 60%. Given the following information, which is better option? They have given annual credit sales, debtors turnover ratio, loss due to bad debt. The only item add on is that 50,000 per month adjustment. Let's start doing it. Same format. Evaluation of credit policy. Particulars existing option 1 and option 2. Existing option 1 and option 2. Sales right 225, 275, 350. Same format 225, 275 and 350. Was a variable cost number. Variable cost is 60% of the selling price. 225 into 60%. 275 into 60%. 90, 110 and 140. Bad debt is 7.5, 22.5, 47.5. 7.5, 22.5 and 47.5. Credit admin is 0, 0 and in option 2 you have to pay how much? 50,000 per month. So 6 lakh for a year. No cash discount. You do the interest cost calculation, then refer the screen. We'll again go ahead with option 1. Again, data is on full cost of sales, problem silent. Any doubts in this? Clear? Let's go through this. AB Enterprises deals in hardware material having current turnover of 30 lakh per annum. All sales are on credit. Collection period is 30 days with zero bad debt. The customers are requesting for increase in credit period. As a result of increase in credit period, sales will also increase. Policy A, policy B, increase in collection period 15 days and 30 days. Sales will go up 3 lakh and 5 lakh. Bad debt is 1% and 3.5%. Selling price is 100 per unit. Variable cost is 50 per unit. Fixed cost is 5 lakh. Required rate of return on additional investment 20. Creditors for variable cost are ready to give 15 days extra credit for the additional cost incurred. What is the implication of this? This is an extra adjustment here. Assume 360 days a year. You are required to analyze the present and propose using the total approach and recommend the credit policy to be adopted. Only add on here is that creditors for variable cost will give extra 15 days credit. What is the implication of that? We'll have to understand. Otherwise, it is almost the same thing. Let's start doing it. Particulars and 3 option. Evaluation of credit policy. Sales less variable less fixed, gross benefit, bad debt, interest and PBT. There will be some changes on the interest cost part because of that creditor adjustment. Sales less variable less fixed, gross benefit, bad debt, interest cost, PBT, and then interest cost is to be calculated where some adjustments are needed. Existing option A and option B. Existing option A and option B. Interest cost, some adjustment will be needed. What is the existing sales? 30 lakh. Option A, 33 lakh. Option B is 30 lakh, 33 and 35. Variable cost is half of the sales. Selling price 100, variable cost 50. Variable cost is half of the sales. Selling price is 100 rupees, variable cost is 50 rupees. Variable cost is 50 rupees. So 15 lakh, 16 lakh 50, 17 lakh 50. Fixed cost is given in the question, 5 lakh. Gross benefit, 10, 11, 50 and 1250. 10 lakh, 11 lakh 50 and 12 lakh 50. No bad debt as of now. Zero bad debt as of now. It has a policy where there is no bad debt. 1% bad debt, 1% of sales, 33,000. 1% of sales, and then huge bad debt, 3.5%. 1% and 3.5%. 1% and 3.5%. 33,000 and 122,500. Now come down interest cost. Full cost of sales. Full cost of sales 20 lakh variable plus fixed 2150 2250. Full cost of sales 20 2150 and 2250. Average collection period. There is one adjustment needed for creditors. Average collection period. What is the original collection period? 30 will become 45, will become 60. Increase in collection period 15 days, 30 days increase. 30 will become 45, 45 will become 60. Debtors full cost into collection period by 360. By 360. Debtors 3,75,000. Now don't calculate interest cost directly. Less creditors. Because creditors are there, so I don't need full money. Some part of creditors are there. Now what is creditors is whatever is the increase in variable cost. Creditor for variable costs are ready to give 15 days extra credit for only the additional cost. What is the additional cost? From 15 lakh, 16 lakh 50, from 15 lakh, 17 lakh 50. For this extra portion, I'm getting a credit. What is the use of this credit? My debtor on the asset side, on the liability side, I'll have creditor, and balance only I'll take a loan. Balance only I'll take a loan. So this, right, creditor 1,50,000, whatever extra sales, into 15 by 360. 15 days credit for the extra variable cost. 1,50,000, sorry, into 15 by 360. 6,250. Whatever is the increase in sales. 1,50,000 into 15 by 360. And this is 2,50,000. 2,50,000 from 15 lakh extra. Whatever is the extra variable cost, on that you get 15 days credit. 10,000. Net investment 166,667. My net investment is only this. Net investment 364,583. On the net investment, we will incur interest cost. Only on the net investment, we will incur the interest cost. Good part here is creditors are giving us extra credit. What is the interest cost figure here? Percentage? 20%. Net investment into 20%. Into 20%. We'll again go ahead with option 1. Any doubts on this? There was an adjustment needed for your creditors here. Go through 16. Okay. Almost similar requirement. You try doing it in your notebook. Refer the screen after you're done. Be little cautious on fixed cost estimation. Be little cautious. Do the estimation and then refer the screen. Only two items are there: bad debt and interest cost. No credit admin, no cash discount. Keep doing it. I'm assuming 360 days and doing it. Solution can be 365 also. The important part is variable and fixed cost breakup. Sales into 75% into 80 is variable, into 20 is fixed. Next time also into 75 into 80 is variable, but fixed same figure, copy paste. Fixed you cannot do into 75 and into 20. Was the profit before tax 48,750 and 370, 800. Be little cautious on the variable and fixed cost part. Clear? We'll go ahead with the proposed policy because it leads to extra PBT. Any doubts in this? Let's come to this. QR Limited, having an annual sales of 30 lakh, is reconsidering its present collection policy. At present, the collection period is 50 days and the bad debt loss is 5% of sales. Company is incurring an expenditure of 30,000 on account of collection of receivable. Cost of fund is 10%. Alternative policies are collection period 40 days, 30 days, bad debt loss 4% and 3%, collection expense 60,000 and 95,000. Determine the alternative on the basis of incremental approach and state which is more beneficial. Now, first I'll discuss if the question says incremental approach, what you need to do. This question you should have solved it this way, and finally write incremental benefit. Incremental benefit, which is 370 minus 348, extra how much are we getting for every alternative as compared to the original, as compared to the any other question we could have done under incremental approach. If incremental approach is positive, that policy is good. If there are many good policies, the one which has the highest incremental benefit, we go ahead and select if at all incremental approach is asked. Second part, this is a question where we are not evaluating the credit policy. We are evaluating something called as a collection policy. Now, what is collection policy evaluation is? Today, it is taking me 50 days to collect the money and bad debt loss is 5%. I can collect the money in 40 and 30, reduce the bad debt. But the problem is I have to spend more on collection expense. I have to spend more on collection expense. So I need to take a call whether to spend. In this question, they have given sales. They have not even given variable cost. They have not given fixed cost. None of that information is there. And I don't need it also. Here, we are not going to do gross benefit and all. After gross benefit, whatever item is there, we will write only those expenses. Four expenses we normally have, three here there: collection expense, bad debt loss, and interest cost. Whichever has the lowest total cost that you have to do, but with incremental approach. What happens in incremental, we'll see. Now, right, evaluation of collection policy. Of collection policy. particulars existing option 1 and option 2. Existing option 1 and option 2. Bad debt, collection expenses, interest cost, total cost. Only cost side analysis. No revenue side analysis here. Bad debt, collection expense, interest cost, and total cost. Bad debt figure is given in the question. Originally, what is the bad debt? 5%. Then by spending more on collection, I'll be able to collect the money faster and also reduce bad debt. 30 lakh into 4% and 30 lakh into 3%. But to reduce this bad debt, I have to pay a price. The price I have to pay for this reduction is extra collection expenses. But another benefit is reduction in interest cost. What is the collection expense figure? Originally 30,000, increase it to 60, 95. Interest cost is on debtors. Debtors will be on sales. No full cost and all. We don't know the cost figure itself. Debtors will be on sales here. Debtors is going to be on sales. No concept of full cost and other things which we can calculate. Interest cost 30 lakh. How much is the collection period today? 50. I'm taking 365. 360 also is okay. Into 10%. 50 by 365 into 10%. 41,096. Solution could be 360, 365. I'm not sure. Anything is okay. Option 1, how much is the collection period? 40 days. So interest cost will go down. 32,877. Then third scenario, it is 30 days. 24,658. We'll put a total and then write the incremental benefit. We'll put a total incremental approach they've asked. We'll put a total. I can take 360 days also. That would have left this rounding of challenges will not come if I take 360. The overall cost is 2,21,096. 2,12,877. And 2 lakh 'Any doubts in these numbers? Printed material can have little difference, depends on 360 or 365. Incremental benefit. What is incremental benefit is from 221 we have got it down to 212. That is an extra benefit. It can be negative also, but here there is a saving in cost. 221 has gone down to 212. 8,219. Similarly, here also we are bringing down the cost. Question specifically uses the word incremental approach, else I don't need this calculation itself. From the original number, always from the original number, 430. I'll go ahead with the third, that is the second option. 11,438 is the incremental benefit, highest incremental benefit. 11,438 is the highest incremental benefit. Any doubts on this? So here it was not an evaluation of credit policy, it is evaluation of collection policy. Any doubts on this? Here we have done 360 days and debt, but more or less the numbers are going to be same whether you do 360 or the other one. 8334 and 11667, we got 8219 and 11438. Go through 18. Okay, this is a slightly unique type of a question. As part of a strategy to increase sales and profit, sales manager of a company proposes to sell goods to a group of customer with 10% risk of non-payment. So this is the bad debt, 10% risk of bad debt. Group will require 1.5 month credit. Sales will go up by 1 lakh per annum. We don't know the existing number. This customer will give me sale of 1 lakh. Production and selling expense 80%. Income tax is brought in. Other question till now tax was not there. And required rate of return after tax is given. Required rate of return after tax is given. Should the proposal be accepted? Also find out the degree of risk of non-payment that the company should be willing to assume. If the required rate of return is 30, 40 and 60, some three situations they have given that they want a return of 30, 40 and 60. Now we'll do it a little differently. Let's start. Valuation of sales to new set of customers. Particulars, original, and then 3 rework is there. Just one rework we will do. Original, 30% return. Original and 30% return. Original and 30% return. They have said 30, 40 and 60. We'll just do original and 30% return. Slightly different question. Sales, what is the sales figure? 1 lakh less production and selling expense, whatever name they have given. I can say variable and fixed. I'll call it as production and selling expense. 80%. Interest cost will come little differently here. Gross profit 20,000, 20,000. Gross profit 20,000, 20,000. Less bad debt 30% return, I'll see what needs to be done later. Originally, what is a bad debt risk? 10%, 10,000. Bad debt 10,000. Profit before tax. Interest, we'll see it little differently. Profit before tax. Less tax. Some tax rate is given in the question. Profit after tax. Debtors return earned. Debtors and return earned. Debtors and return earned. Profit after tax 5,000. Debtors and return earned. Now listen. Debtors first calculate. Calculate the debtor. How much is the credit period we are giving? 80,000 into 1.5. 80,000 into 1.5. Listen, with 10,000 investment, we are earning 5,000 profit. With 10,000 investment, we are earning a profit of 5,000. So return earned is 5,000 on 10,000 into 100. 50% return. After tax. After tax, we are earning 50%. Question wanted us to earn a return of 25%. Minimum required return after tax. After taxes, 25%. And we are earning a return of 50%. We can go ahead with the credit. Or what you can do is after PAT is calculated, less interest. What is interest is 10,000 into 25%. 10,000 debtors into 25% after PAT. After PAT is calculated because required return is after tax, and then the net benefit is 5,000 minus 2,500, 2,500. Both the approaches will give the same conclusion that you can give credit. Now, why I am doing this approaches in the other side, right? You are done with this 50% part. On the other side, I want 30% return. I want 30% return. Debtors is 10,000. Reverse working PAT. 3,000. Reverse working PAT 3,000. PAT 3,000. Tax and PBT number. Bad debt is balancing figure. Why balancing figure? I'll explain. Bad debt is balancing figure. How much is bad debt? Now, what question is saying is you calculate what should be the degree of risk of non-payment so that I can earn a return of 30%. If bad debt risk goes down, I can earn more return. Bad debt risk goes up, I will earn lesser return. So, if I want 30% return, bad debt risk will be 14 percentage, 14,000 on 1 lakh, 14% risk. And if it is original 10% risk, you will earn 50% return. You wanted only 25, but you will earn 50% return if risk is only 10%. If bad debt is 14%, then it is 30% return. And they're asking for 40% what will happen, for 60% what will happen. You can keep doing all those situations. So the degree of risk of non-payment is 14, 12 and 8. 14, 12 and 8. The degree of risk of non-payment is 14, 12 and 8. As the bad debt risk goes down, I can keep earning more and more return. Clear? Any doubts on this? Done. In case income tax is there, then and if the required return, some question income tax will be there, but the required return will be before tax itself. If it's before tax, deduct interest before tax, get PBT, deduct tax, get PAT. If the required return is after tax, PBT, less tax, PAT, and then deduct interest cost. Then deduct the interest cost. This will be the last question we will do. Go through 19. Go through 19. they've given a financial statement. They've said existing credit term is 1 by 10 net 45. Collection is happening in 30 days. What is 1 by 10 net 45 is? You will get 1% discount. You'll get 1% discount if you make the payment in 10 days. Otherwise, you have to make the payment in 45 days. 1 by 10 net 45 means 1% discount if the payment is done in 10 days. Otherwise, make the payment in 45 days. Some people will be paying in 10 days. Some people will be paying in 45 days. On an average, I'm getting money in 30 days. The current bad debt is 1.5%. In order to accelerate the collection process, we want to give 2 by 10 net 45. We want to give 2 by 10 net 45. If I do this, sales will go up by 1/3, bad debt will increase to 2%, and collection period will decline to 20 days. Credit period allowed by the supplier is 60 days. Generally, OPEX are paid 2 months in arrears. Variable expenses of the company constitute purchases of stock in trade. Opportunity cost of investment in receivables is 15%. 50% and 80% are availing some cash discount. Tax rate is given in the question, but the return requirement is pre-tax only. Opportunity cost of investment in receivable, they're not said after tax, but tax rate is given. Company considers only the relevant or variable cost for calculating the opportunity cost. For opportunity cost purpose, only the variable cost is considered. Fixed cost also is not considered in the calculation for debtor valuation. Assume 360 days in a year, 30 days in a month. Should the company change its credit term? Everything is okay. It's a very simple question only, but the sales figure is not given directly. How will you get sales figure is, right? Debtors equal to, this is from the balance sheet. Debtors equal to sales into, in the balance sheet, it's always on sales only. Sales into 30 by 360. Today, 30 days it is taking. Debtors equal to sales into 30 by 360. 1 lakh equal to sales into 30 by 360. This will give you the sales figure. Sales figure is 12 lakh. And variable cost is also not given. They said credit period given by supplier is 60 days. Generally, OPEX are paid 2 months in arrear. Operating expenses are paid 2 months in arrear. Variable expenses of the company constitute purchases of stock in trade and operating expenses only. Stock in trade and operating expenses only. So what will happen is 1,56,000, which is the creditor, is equal to annual expense into 2 by 12. Annual expense into 2 by 12. These two numbers are not given directly in the question. They have given in a hidden manner. Next, right? Current liability is equal to annual expenses into 60 by 360. Annual expenses into 60 by 360. This will give you the expenses figure. 60 by 360. 2 months in arrears. How much? 9,36,000. Beyond this, we can now then start doing the normal analysis, where you will only extra adjustment is cash discount is there. Any doubts on 936? Let's start. Evaluation of credit or evaluation of new policy. Existing and proposed. Existing and proposed. Sales We just now calculated the existing sales, 12 lakh. In the revised policy, what is the sales? Some increase they are saying. How much increase? 33.333 percentage. 16 lakh. Less variable cost. How much the variable cost originally? We just now calculated 9 lakh. This will also go up with the sales. 936 plus 33.3333 percentage. How much? No, no. 12 lakh 48,000. 12 lakh 48,000. Fixed cost is not given. Gross benefit. Gross benefit. Gross benefit. How much the gross benefit? 2 lakh 64,000 and 3 lakh 52,000. Less bad debt. Bad debt. How much the bad debt risk? 1.5%. 18,000. And then you said how much? 2%. 32,000. Then less cash discount. 12 lakh into. Today everybody is not opting for discount. 1% discount I give, and later I am giving 2% discount. 1% discount and 2% discount. And the question says 50% of the customer and 80% of the customer will avail discount under the existing scheme and the liberalization scheme. So only 50% people are taking discount. So I'll give a discount of 12 lakh into 50% people into 1%. 50% people into 1%. And this side 16 lakh, 80% people into 2%. 80% into 2%. 25, 600. Interest cost is to be calculated, but before that we'll have to calculate the debtor figure. Variable cost of sales, only variable cost we have to take. 9 lakh 36 and 12 lakh 48. Average collection period. Average collection period 20 days and sorry, 30 days and 20 days. Debtors 78,000. 69. Interest cost is debtors into how much is the interest cost? 11,700. It says 15%. If they had given after tax, no, the same amount we calculate, but we'll reduce after PAT. Now we'll reduce at PBT and then show less tax and PAT. Interest cost 11,700, 10,400. Profit before tax, less tax and profit after tax. If the interest cost was given after tax, get PAT and then deduct the same 11,700. What is the PBT number? Okay. Two lakh. Are you getting 84,000? Last question. If at all I was to deduct that interest cost, I would have deducted at PAT. Here tax rate is given, but that's just to calculate the number. What is the tax rate given? Tax at 30%. 28,300 into 0.3. 68,490. And the other one is 85,200. 159,810. 198,800. Clear? So we should go ahead and change the credit terms because it leads to higher benefit. Now, I think two more questions are there which you can kind of manage, and factoring part you'll have to take care. So I'm done with, I can say, approximately 75% of working capital side. Some more area is pending. Investment decision, what you do is whatever questions I've covered in the material, just try to cover them. Doing many questions will not help in that area because most of the time a new question will only come. So practice whatever questions are given in the material, and every area please go through the charts fully. I've not covered all the concepts in these 120 questions. There are some concepts which could have been left out because this will have 90-95% kind of a coverage, but some concepts, as I do, I find certain concepts could have been covered, but I didn't want to cover more than 120 questions, so I had put a limit of 120, and that's how I selected the important ones. With this, my FM revision is over. Tomorrow we are starting with costing revision. In costing, I'll keep it as 6:30 to 2 o'clock. We'll keep it as only 2 o'clock. I will see how I cover that extra whatever is left over area. 6:30 to 2. Tomorrow onwards we start with costing revision. FM part, whatever we have done in the material, try to cover those questions again one more time if time permits. And obviously the areas which are left over, investment decision you have to do, and working capital side you have to do, and MCQs from the concept book. MCQs from the concept book. Clear? I'll end with this thing. Thank you.